Hello people, welcome back. So let's continue our marathon discussion. So next big ticket topic we are taking is consolidated financial statements. There is a significant overlap or similarities between amalgamation and consolidation. Hence we are doing consolidation now. Right. So first, there are three consolidation in our syllabus. One is holding company, subsidiary company consolidation. One is investor and associate company consolidation. Another one is joint venture consolidation. Among these three, the most important at inter syllabus as well as in CA final syllabus, hands down, is consolidation. So this particular consolidation will stay with you at CA final also. It will come. Okay. Here what we are studying is accounting standard 21. Okay, that is talking about consolidation between holding company and subsidiary company. So yes, so whatever you are learning now, keep a track of that, because same thing will come as Ind AS 110. There are three standards targeting consolidation at CA final level. Okay, and say very good important topic at final level also. So it pays rich dividends if we do this properly and remember it. Okay, all right. So as we said, so currently what consolidation we are talking about is holding company and subsidiary company consolidation, which is governed by which standard, sir? Accounting standard 21, which talks about it. Fine. Now, consolidation simply means what? To consolidate. What does the term consolidate mean? Forget about accounts. Just the term to consolidate means what? Adding up, right? So when we consolidate means adding up. So when we say consolidated financial statements, essentially what we are saying is add two or more company ka financial statements. That's all. Simple addition. Correct? No. I mean, so much build up not necessary. No. Addition though we have been learning from our KG only, no sir. Nursery, now they start addition. Correct? Why do we need standard and all for addition? Take simply two company ka balance sheet, add, damar. Take two company ka cash flow statement, add, over. Why do we need a standard for this? See, consolidation is simply adding up, right? To add up something, where is the necessary of a standard, sir? Why do you think a standard was necessary, and that too an important standard was introduced here? No response. Okay, I will only tell in the interest of time. Yeah. Now the papa you have had sapadu and also come more. So if I ask, they be like, that feeling may come more. Sir, yes, consolidation is definitely adding up, right? But it is not random adding up. So like, can I take ArivuPro ka financial statement and add it up with Reliance financial statement? Any random company, today I saw Reliance, I will add? No. So when we are talking about consolidation, AS 21 will only come into picture when there is something called control. When there is something called control. Only if there is control, then arises the need to apply which standard? AS 21. Alright. So that's the key factor that you look for, control. If one company is able to control the other company, then only we prepare consolidated financial statement as per AS 21. That is one. So how do you get control? Very simple. If one company owns more than 50% voting power in the other company, the investor company is able to control the other company. That investor company, we call it as holding company. The investee company, or we call it as subsidiary company. So that's where the need. And it is not simple addition, as in fact when I used to start AS 21, I used to give a background why it is and all. Just 1 minute, I'll just take and I'll give you why or what are the things we need to keep in mind and why it is not a simple addition. Let's take. So first thing we have sorted is that now what's a consolidation can happen only between which two company? Holding company and subsidiary company. So the key aspect that we look for is C as in control. Okay. Now let's say holding company has purchased 90% shares in subsidiary company. H Limited has acquired 90% equity shares of S Limited. Let's assume that way. Okay. So for H Limited, can I say it is an investment? Because H has acquired shares of S Limited. So for H Limited, it is an investment. Let's say this investment was purchased for 5 crore rupees. H purchased the stake by paying 5 crore rupees. And we have learned investment is shown at what price? Cost price. Now, whatever you pay for it, and that's where you show the investment in your books. But if you analyze the same transaction from S Limited perspective, H has purchased. What happened? Huh? Sorry? Screen is not visible. Huh? I thought I did something wrong. I was wondering what went wrong. Okay, can someone just call the person out there? Or maybe 1 second. I'll try here. This is what. Now it's okay. Huh? There's a problem in the TV. Now it came. That is also okay. That TV is okay. That TV was forever okay. This was only the problem. Okay, now this is also sorted. Now can I continue? Yes, Vastu is sorted. So let's move forward. Now for H Limited, it is an investment. Correct. For S Limited, H has purchased equity shares of S Limited means, can I say S Limited has issued equity shares to H? When a company issues equity shares for S Limited, it is a share capital, right? And S Limited is showing the same component as equity share capital. But equity share capital, you will show it at cost price or face value. Equity share capital is shown at face value. Face value may be 5 crore or it could be 1 crore also. It could be 10 lakh also. Because when you buy the investment, you buy it at market price. Correct? Now, if you want to buy today Reliance ka share, today's market price you have to pay and buy it. But share capital is always shown at what value? Now, how do you consolidate this? A transaction has happened. For one company, it is an investment, meaning it is an asset. The same component for another company is a capital or a liability. Asset has a debit balance, liability, share capital has credit balance. Now, how do you go about consolidating this? And moreover, is the value matching? Value also different. Value also is different. So like this, these are like some of the issues that turn up in consolidation. There are many issues which we have discussed. What if subsidiary company is there outside India? If it's a foreign subsidiary, which it will not come here, say a final may will come, right? I'm just saying, right? So what initially you purchased only 20%, then you added 70%. This we call it a step acquisition. Again comes in CA final, India is 110. So like this, there are 101 issues will come. So it is not plainly adding up. There are many things we need to keep in mind. Okay, don't freak out. Majority of them are not there in intermediate. It will come at final level only. So that way it's fine. You still have 1 year more to kind of get there. But overall, did you understand that it is not simple addition, but there are other things to be considered here as well? Yeah, that is one. Another factor, just for the sake of questions, if I'll have to address, sir, again, tell me the heading of balance sheet. No, matlab heading nahi. Let's start with the company equity and liabilities. Below that, shareholders funds. Okay, specify on this. Shareholders funds. Under that, what do you show? Share capital, reserves and surplus. That means share capital and reserves and surplus belongs to shareholders. Who are the shareholders of S Limited? H Limited to the extent of 90%. H Limited to the extent of 90%. Others to the extent of 10%. That others here we call it as MI, as in minority interest. Yes, no? That means all the reserves and surplus of the subsidiary company has to be distributed in the ratio of what? 90:10. 90% allocation has to be done among the holding, 10% allocation has to be done among minority interest. This is another working. Like this, a lot of things will come into picture. We'll anyway address through this through one question, just saying. But overall, are we okay? The first time learners, I mean. Okay, super. This I've just written as a summary. I will not go to this for the time being. We will follow. For consolidation, if you remember our regular class, there used to be 7 working notes we used to prepare. We used to solve almost every consolidation problem in this working notes only. And then finally, we used to prepare balance sheet. So we will revise also in the same manner so that there will be some continuity. First, I'll call it out. Some of the things you may understand, some you may not understand. After this, I will take up a question. There are only 2-3 more concepts. We'll do that and we'll take up a question where probably you will get more clarity over these adjustments. Okay. All right. First, sir, though consolidated financial statement is simple addition, before we add financial statements, you need to prepare certain working notes. And specifically in our approach, we prepare 7 working notes before we put up the main solution. First working note is to find out the shareholding percentage. How much shares holding company is having in subsidiary company. Sometimes this will be directly given to you in the question. If it is given, then should we have to prepare it or cut it off? Cut it off. If they have not given shareholding percentage, find it. Like in this previous example, how much shares of S is being held, or rather H is holding to the extent of 90. Minority interest or others are holding to the extent of 10. Finding out this is the first working note. That's what I'm trying to say. Sometimes they will give it to you. Sometimes you may have to find it out. That is one. Second one is to prepare the general reserves of the subsidiary company. General reserve of subsidiary company. Third one is P&L account ledger preparation of subsidiary company. Okay. Again, I'll tell you why we do this. Fourth one is analysis of reserves in surplus of the subsidiary company. You know, before this working note, I said all the reserves in surplus of subsidiary company has to be allocated. Among whom? Holding company and minority. That allocation will happen in working note number 4. And this is the most important working note in your consolidation questions. If you get this right, you're sorted. I don't think so anywhere else you will go wrong. If at all you go wrong, in my opinion, it's going to be in this. Otherwise, no. Okay. So this is your working note number 4. In this working note, essentially what we are doing, we are distributing the reserves in surplus of subsidiary company among holding company and minority interest. So before we do this distribution, we categorize. We categorize the reserve as what? Pre-acquisition reserves, post-acquisition reserves. Name itself is saying pre-acquisition. Pre-acquisition means before H Limited acquired 90% shares in S Limited, how much reserves S Limited already had. The reserves which the selling company or subsidiary company had before holding company became shareholder. That to be referred to as what, sir? Pre-acquisition reserves in surplus. Question will give you the data of that. Any reserves in surplus which came after H Limited became the shareholder, after holding company got control, what and all reserves in surplus S Limited made, such reserves we call it as post-acquisition. First, the reserves in surplus has to be split between pre and post, and then allocate this reserve among the H and minority interest in the shareholding percentage. In our example, the shareholding percentage was 90% and 10%. It's not 90-10 every case. The question will specify the percentage. Okay. Can I go for the next one? All right. Now, people, you are preparing consolidated financial statement. Taking the same example, H Limited as how much shares in subsidiary company? 90%. That means who is holding the other 10%? We can call it as others, but AS21 uses the terminology minority interest. Working note number 5 is your minority interest. Because they own 10% shares in subsidiary, so they also have to get reflected or shown in consolidated balance sheet. At what value minority interest will come in consolidated balance sheet? That you will figure it out in working note number 5. And this is pretty straightforward. As you only told, I asked you the question. Remember, under shareholders funds, what do you show? Under shareholders funds, what do you show? Share capital, reserves and surplus. That means what belongs to the shareholder? Share capital, reserves and surplus. Even minority interest as a shareholder. So what belongs to minority interest? Their share of share capital. Their share is 100% or 10%. So in this working note, 10% of equity share capital will be adjusted or will be allocated to minority interest. And what? Only equity share capital is what shareholders will get, or also reserves and surplus? Reserves and surplus. But hang on. Now the reserves and surplus of subsidiary company, is it same or is it already categorized? As what? Pre and post. So minority interest, guys, they will ask for their share of pre-acquisition profit as well as their share of post-acquisition profit. This you already found out in the above working note. This you just need to add it up. And this added final number will come in consolidated balance sheet. I'm just giving you a quick overview. You'll have a little better understanding in the numbers in case you're doing it for the first time. This is your working note number 5 to find out the minority interest ka balance. Sixth one. Sir, remember in amalgamation we found out goodwill. Here also same goodwill will come. Goodwill sometimes is also referred by the name as cost of control. Right? You can say call it as cost of control or goodwill, or instead of goodwill, you may also get a capital reserve. Right? Here we calculate goodwill reserve in a slightly different way. But whether you calculate goodwill in amalgamation way or this way, final answer will be same. But I would prefer this way because of certain adjustments. I will take up maybe, if time permits, one question to prove that this method and amalgamation method will give you the same answer. What is amalgamation method, by the way? You compare PC with net assets, remember? Right? That way also you can calculate, but in consolidation way, there are a lot of other adjustments which can cause some confusion. So this will be much easier approach, and all our questions we have done like this, right? So anyways, that we will see based on the availability of time, proving it's not possible or not possible. Right? So how do you get goodwill or capital reserve here is, let's go one step back. Remember I discussed this issue with you. Can you tell me what is this issue? What was this issue? Perfect. Sir, when this transaction happened, for H Limited, it is an investment, which is an asset. For S Limited, it is a share capital. Same component, can you show it as both asset and capital? One component, can you show the same component both as an asset and a liability? I mean, can you show these two or nullify? This investment also will not come in consolidated financial statement. The share capital also will not come. They will get nullified because you can't show. Can I show the same component both as debtor and creditor? Either it will be a debtor or a creditor. So same thing here also. So hence we don't show this, but rather we will nullify. But the problem here is asset is shown at what value? 5 crore. Share capital is shown at what value? There is a difference. The differential element becomes your goodwill or capital reserve. So that's what I've written here as a step. So what are the two things we are comparing for goodwill here? Investment, share capital. Keep that in mind and see this working. So to calculate goodwill or capital reserve, first we will take cost of investment, which in our example was 5 crore. Correct? Then we deduct a few things. First, if there is any pre-acquisition dividend, we reduce this. First, I'll call it out. Then if you have any pre-acquisition profit, reduce it. Then the share capital ka holding company's share in the share capital, you reduce. By doing this, if you get a positive number, it's a case of a goodwill. If you get a negative number, it's a case of capital risk. Even if you don't know a thing, just plug the numbers into format, you will get the answer. I've told the logic of each of this. Little, I will go ahead into this. We can't go deep dive because obviously the lack of time. Okay, so plugging in these, you get something called goodwill or capital reserve. I'll explain what is these two, maybe with a number, numerically probably it's much easier to connect. Okay. Can we go for the last one? Or is it okay? I'll maybe try explaining this through words for like 1 minute. If it doesn't understand, we'll take up maybe more number. Are you willing to give me that one chance? Okay, fine. All right. Sir, excuse me. What is this pre-acquisition dividend is? Let's say H Limited acquired this 90% shares on 1st May 2026 in S Limited. So H Limited got control over subsidiary company on which date? 1st May. 1st May. Okay. No. On let's say 1st June 2026, S Limited, no? They declared a dividend. Fine. Okay. Now people, on 1st June, is H Limited already a shareholder? On 1st June, is H Limited already a shareholder? Yes. Who will get the dividend? The shareholders. Who declared the dividend here? S. So who will get the dividend of S Limited? H Limited and minority interest. Correct? Okay. But this dividend, no, is for 2025-26. Meaning it is not for current year, it is for previous year. Because that's how company work. No, first the year has to get closed. Then audit will happen. Right? Then the board of directors will give a recommendation of dividend, and finally it will get approved in AGM. Yes, so all the sambrama or festivities will take some time. So this year ka, that is previous year ka dividend, company was able to declare only on 1st June, maybe because the AGM happened on that particular date. Is it fair enough? But by this date, H Limited was already a shareholder. Now means, will H Limited get this dividend in reality? Will H Limited get this dividend in reality? Yes. But touch your heart and tell, should H Limited really get this dividend? No. Why? Because is this dividend for the current year or last year? This dividend is for the last year. And was last year H Limited a shareholder, or they became only in the current year? When I say current year, I mean to say 1st April 2026 to 31st March 2027. This is the year we are talking about as current year. But the dividend is for this year or last year? Was last year H a shareholder or not a shareholder? So logically speaking, H Limited should not get a dividend. But companies act, the dividend doesn't work like that. On a particular day, we call it as a record date. We check who is a shareholder. Whoever is a shareholder, they get the dividend. They get full dividend. If your name is not appearing on the record day, you will not get dividend. As simple as that. So on the record day, H Limited name is already appearing in the register. So will H Limited get this dividend? Yes. But in reality or logically, should they get it? No. Yes. So hence, what accounting standard 13? Accounting standard 13 that talks about investment accounting. What AS 13 says is, boss, this is not normal dividend received. This is not a normal dividend received, because this dividend is not for current year, it is for previous year. What is the journal entry for normal dividend received? Bank account debit to dividend income, and dividend income account debit to P&L. Bank account debit to income and income to P&L. This is the journal entry for income received. This is the journal entry for income transferred to P&L. Yes, sir. But is this a normal dividend? Logically, should you get it? No. Hence, AS 13 says, boss, this is not normal dividend, since it is not for the current year but for the previous year. Hence, we give a fancy name to this. That fancy name is what? Pre-acquisition dividend. And name is good only, because this is a dividend not for current year. This is a dividend before you acquired the shares. Right? Before you acquire the share only, we call it as what? Pre-acquisition. Pre-acquisition means before acquisition. Hence, in this example, the dividend which H will receive, is it a normal dividend or is it a pre-acquisition dividend? It's a pre-acquisition dividend. And AS 13 says, boss, if you have received pre-acquisition dividend, don't pass your normal entry. Don't pass this entry. Don't pass this entry. The journal entry for pre-acquisition dividend is when you receive it. Anyway, H has received now. So H will pass the journal entry, bank account debit. Let's say they received a dividend of 1 lakh, assumption. Bank account debit, 1 lakh. Instead of treating this as an income and transferring it to P&L, adjust it against the cost of investment. Don't transfer this amount to P&L account, but rather reduce it from the cost of investment. That is what, this is a recommendation given by which standard? AS 13. Okay, Naji. Sir, why is it saying like that? Common sense, no, sir. Or maybe let's make this number a little bigger, because I think, or okay, fine. I'll change this number only. Let's say H Limited acquired this 90% shares by paying 50 lakh. Okay. And they received how much dividend? 1 lakh. No, sir, use your common sense. On one hand, H is paying how much to get control? 50 lakh. On another hand, they are getting a pre-acquisition dividend, how much? 1 lakh. Net is the cost of the investment really 50 lakh or 49 lakh? 49 lakh. Because H, in reality, they did not pay 50, they only paid 49. Because though they paid 50 lakh, they got back 1 lakh in the form of dividend. Yes or no? Hence, AS 13 says, reduce it from the cost of investment. Your investment cost is not really 50, it is 49. That's the reason we pre-acquisition dividend, if it is there, we reduce it from cost of investment. What the logic of it? Pakka, everybody? Meaning is okay? Done now. Alright, the next component is you have to reduce something called pre-acquisition profit. Remember in working note number 4, what did we do? Go back. Tell me, what did we do in working note number 4 there? Reserves and surplus of subsidiary company we categorized into what? Pre and post. And then only we apportioned among shareholders. Yes or no? In their shareholding percentage. Same logic as dividend for pre-acquisition profit also. Okay. Pre-acquisition profit means what? Pre-acquisition profit means what? Name itself is saying, don't worry, don't take too much load, concentrate on the name. Pre-acquisition reserves and surplus or pre-acquisition profit. Perfect. Any profit made by subsidiary company before holding company became the shareholder. Before holding company became shareholder, how much ever profit subsidiary company made, that only we call it as pre-acquisition. Look at this example and tell me what is pre-acquisition period. Look at this example and tell me what is pre-acquisition period. Pre-acquisition period. 1 month. 1 month. 1 month. Current year starts on which date? 1st April. H Limited became shareholder on which date? 1 month later, which is 1st May. So any profit made by the subsidiary company before 1st May, any profit made by subsidiary company before 1st May is what? Obviously pre-acquisition profit. Yes or no? Correct. Yo, alright. Now, again the same drama. Everyone got the pre-acquisition profit ka identification? Logically, should H Limited get April from 1st April 2026 to 30th April 2026, whatever profit subsidiary company has made, that only we're calling it as pre-acquisition. Pre-acquisition profit or pre-acquisition reserves and surplus. Should H Limited get any share in this? Should H Limited get any share in this? No. Why? Because these were the profits made by subsidiary before holding company became shareholder. So holding company has no role in this. So logically they should not get, but practically will they get? Yes, because company works on all or nothing approach. Either you get everything or you get nothing. Why this is? I used to give the same example if you remember. Let's say, what's your name, Acha? Vimalesh purchased, let's say, TCS ka shares. Tata ka shares Vimalesh purchased at 10 a.m. 10 o'clock in the morning he purchased. 10:30 he got bored and he sold off. 10 o'clock he purchased. Half an hour later he sold it. Now Vimalesh is writing a letter to Tata company. Look at his audacity. He wrote an email. Half an hour, 30 minutes I was holding your company shares, give me dividend. Half an hour I was holding your company shares, so give me dividend. Like this, thousands of people will buy the shares for 1 minute, 10 minutes also possible. Do you think we'll go on giving Reliance? Tata will say, oh, Vimalesh, so nice of you. 30 minutes you are holding my shares. Take that. Come, I will do full amala and all I'll do it for you. Will it work like that? So companies always works on all or nothing approach. The moment you become a shareholder, whatever company has belongs to you. The moment you sell the shares, nothing belongs to you. It's a little spiritual. When you're there, everything is yours. When you're nothing, nothing is yours. So that one approach here at the end. Okay, now so same drama. Okay, did you get the point of it basically? So logically, should holding company get a share in this pre-acquisition profit? No. But practically, will they get it? Yes. Practically, will they get it? Yes. That means check here. Is the cost of the investment really 50 lakh or they are also getting some pre-acquisition profit? On one hand, they are paying 50 lakh for cost of investment. On another hand, holding company is also getting some share in pre-acquisition profit. So is the cost of investment really 50 lakh or lower? Let's say pre-acquisition profit is 10 lakh rupees. To get more context, pre-acquisition profit is how much? Or maybe this, no problem. 10 lakh is a pre-acquisition profit. Will holding company get full 10 lakh or their share? What is their share? H Limited ka share is 10 lakh ka 90%, which is how much? 9 lakh. Correct? Okay, G. So on one hand, holding company paid how much to get the shares? 50 lakh. On the other hand, their pre-acquisition profit share is how much? 9 lakh. So is the cost of the investment really 50 or 50 minus 9? 50 minus 9, which is 41. Because this they are not paying. This they are getting. This they are paying and this they are getting. Hence, what should we do for this? You tell me in formula. What should we do for this? Pre-acquisition profit you should reduce. That's what we have done here. Take the cost of investment, from that reduce pre-acquisition dividend and also reduce pre-acquisition profit. Total pre-acquisition profit or H Limited ka share? Their share of pre-acquisition profit you reduce. Okay, now by doing this, what are you going to get? By doing these three, what are you going to get? The net cost of investment. The net cost of investment. Okay, Naji. Now, For holding company, it is an investment, but for subsidiary company, it is a share capital. Can we show same component both as capital and investment or net off? Net. So compare this cost of investment with the share capital. Total share capital or holding company shares? This is total or holding share? Holding share. I mean, this also should be total share capital of subsidiary company or holding company share? Holding company share, which is how much in this example? Energy. Compare this with this. If it's a positive number, it becomes goodwill. Negative number, it becomes capital. Manageable. You got the little bit reasonable assurance as to how the numbers are looking up. If you want time permits, as I said, I'll prove you the other method also. First, let's finish up one basic question on this. One question on this. We'll talk about that. I'm just touching upon the main things. Bonus ka, there are multiple ways the question can be asked, but all those are number driven. General audience, yeah. So that's the thing. Yeah. Can I go further? Yes. All right. So working note number 6 is over. What is the intention of working note number 6? To calculate goodwill or to calculate capital reserve. Through this working note, two things will get nullified. What are those? Two things will get nullified here. One, investment will get struck off, and investment will get struck off on even what? Share capital of subsidiary company also will get nullified. Instead of these two, what will come? Goodwill or capital. That calculation happens in this format through working note number 6. It's not necessary you have to present like this. It's just that all our questions we have done it in this, so I'm continuing. If you have done it through another approach, it's okay. You can change the numbers and all that. That is your call. Can I move on to the last one? The last working note is consolidated reserves and surplus. Sir, if you are preparing consolidated balance sheet, then that means you want only holding company ka reserves and surplus, subsidiary ka reserves and surplus, or total. In consolidated number, you'll always have to show the total. So in consolidated balance sheet, we can't show reserves and surplus. We have to show consolidated reserves and surplus. So how that is calculated is what I'm trying to present in working note number 7. What you do here first is take holding company ka all the reserves and surplus as it is. Because the drama is only with respect to which company? Subsidiary company. Because subsidiary company ka reserve first has to be split between pre and post. And then you will have to allocate among holding and minority interest. So all the drama is only coming for which company? Subsidiary. Holding mein there is no drama. Take the reserves and surplus as given in the question. Ditto number, same number. Okay. Then. Go one step back. Subsidiary company ka reserves and surplus we split as what? Pre-acquisition profit, post-acquisition profit. And that pre further we allocated among holding company, minority. Post again we allocated further among holding company and minority. Should we have to do anything for pre-acquisition share of minority interest, post-acquisition share of minority interest, or already done? Already done. Which working note? In working note number 5 only, pre-acquisition and post-acquisition share of minority is already considered. I mean, this is considered, this is considered. Yes, sir. Yes, people? Okay. Now, holding company's share of pre-acquisition profit ignored or already considered? Holding company's pre-acquisition profit ignored or considered? Considered. Which working note? Working note number 6. If you remember, from cost of investment, we reduced pre-acquisition profit, holding company ka share. I mean, this is ignored or done? Done. Which is the only thing unticked over here? Holding company ka post-acquisition profit. Okay, now? Post-acquisition means what? Tell me once again. Post-acquisition ka meaning. After the holding company became shareholder, subsidiary company made how much profit? Logically, reality-wise, should H Limited get it? Yes. Because these are the profits made after holding company became shareholder. So, logically and reality-wise, they should get it. Right? I mean, this is what? Abnormal or normal only? This is your normal profit. So, add it to working note number 7. Take the holding company's reserves and surplus and add what's a post-acquisition profit share of the subsidiary company. That way, what any of these numbers are pending or all of them are considered? All of them got considered, but at different places because their nature is different as such. Okay, Naji? So these two are done now. Stock reserve, I'll come to it in a bit. I'll just tell you, if there is stock reserve adjustment, pre-acquisition dividend adjustment, two more, you'll have to do it. We'll come to this, why we do this. Maybe I'll take it numerically, or when I'm doing more concepts, I'll tell you. Okay. Now people, what have I written here? Capital reserve. What is this? Sir, in working note number 6, either you may get a goodwill or you may get a capital reserve. Where will you show capital reserve in balance sheet? Under reserves and surplus only, no? So if working note number 6 gives you capital reserve, that capital reserve will be considered over here. If it is goodwill, if working note number 6 gives you goodwill, you will show it under intangible assets. That's all it is. So this capital reserve gets considered here as a reserve. These two, for the time being, we have put it on hold. Let it be there for some time. Just give you a minute just to quickly wrap your head around it. Any doubt or okay? Okay for me to proceed? Don't worry, sir. How will we remember it? Remembrance can come only through practice. Now, am I seeing all this and calling it out? Am I not just telling it right like that? I'm not Bruhaspati. It is just that we have practiced it many times, so it is automatically registered. So the more and more you practice, all this will come. And good thing about this, I've kept the same format for almost all the questions. So one or two, if you do in the same format, from the third one, you don't have to solve. You can only simply review it because format would have got registered. Fine, people. So I'll move on further. Unrealized profit. Sir, this unrealized profit is a new concept to us, or we have already done this? We used to call it as stock reserve. Yes, sir. Tell me, there stock reserve, what was the funda? In amalgamation, what was the thing that we talked about stock reserve? Stock reserve will come into picture when purchasing company and selling company are doing some transaction in the form of purchase and sales. Correct? And do you think this transaction will happen at cost price or selling price? Selling price. And some profit element will be included in closing stock. Same drama here also. But here the drama is not between two random companies. It is between holding company and subsidiary company. Okay. Now there could be two possibilities that could occur here. One, a holding company can sell the goods to subsidiary company. A holding company can sell the goods to subsidiary company. Now, sir, holding company is big daddy, correct? Subsidiary company is a child. Yes. So if you visualize the hierarchy, holding, parent. Now arrow is going up or down. Holding is selling to subsidiary. So this we call it as a downstream sale. So if holding sells the goods to subsidiary company, we call it as what, sir? Downstream sale. Sometimes they may not say H Limited sold goods to S Limited. They may say downstream sale is 2 lakh. Downstream sale simply means holding company has sold goods to subsidiary. Now holding is here, subsidiary is here. If subsidiary has sold goods to parent, means arrow is looking up. That becomes what? Upstream sale. So both can be asked. So if downstream sale occurs, what to do? If upstream sales comes, means what to do is what I've just tried to call out here. Okay. Now, excuse me. Now people, let's say the cost of the goods is 1 lakh, but the selling price is 1,20,000. Let's say H Limited, they purchased the goods for how much value? 1 lakh, but they sold it to subsidiary company for how much? 1,20,000. I mean, was there any profit made through this transaction? How much? 20,000. Correct? Now people, H Limited is a separate legal company, S Limited is a separate legal company. As long as they are separate companies, one company can sell the goods to other company, or rather one company can also purchase the goods from other company. But go ahead and remind yourself the chapter name. What is the chapter name? Consolidated Financial Statement. In Consolidated Financial Statement, are you treating holding company separately, subsidiary separately, or are you summing it up? You are adding them. That means you are considering them as separate or one company. One company. Sir, now if there is only one company, can you show this profit? If you show this profit, it is like telling I made a profit of 20,000 from myself. I transacted with myself and made 20,000 rupees profit. Sounds logical. No. That means when you prepare consolidated financial statement, this profit is shown or eliminated. Because we are not treating them as two separate companies. For CFS, for consolidation purpose, we are treating them as one. If you show this profit, then it like gives a weird feel that you made a profit from yours. That hence this particular 20,000 profit you have to eliminate. Where you have to eliminate? In H limited books, S limited books, or consolidation books. This elimination will only happen in CFS, as in consolidated financial statement, not in the individual financial. Individual financial statement we call it as SFS. SFS means standalone financial statement, or you can also call separate financial statement. There you don't have to eliminate. Elimination will only happen where? Consolidated financial statement mein elimination will happen. Done, Anji? Now the question will arise, we have 7 working notes, right? Where should we consider this 20,000? That's very simple, in fact. Now that's where you need to understand what kind of a sale is it. Is it an upstream or a downstream? Now, this is a case of what? Parent or holding company selling the goods to subsidiary company. So it is a downstream sale. Sir, if holding company is selling goods to subsidiary company means who will make profit? Purchaser will make the profit or seller will make the profit? The seller of the goods will make profit. Who's the seller here? Holding company. Yes, sir. Now go back to your working note. Is working note number 2 targeting holding company? No. 3? No. 4? No. 5? No. 6? No. That means which year? So that is where I've written this. Okay, now. So this particular unrealized profit, what we calculated here, it will get eliminated from working note number 7, which we had kept it on hold. I think it is sorted now. Correct, people? It may be there in the question. It may not be there. That is up to the examiner to ask. But usually these are the things which examiner usually asks in exam. Done now. Sir, it could be other way around also, as in subsidiary company selling the goods to parent. That means arrow is going up. Arrow is going up. So now subsidiary has sold the goods to parent or holding company. Who will make the profit? Seller. Who's the seller here? Subsidiary. Correct? Now subsidiary ka profit, are you leaving it as it is or are you analyzing them? That means if this scenario happens, and if there is any unrealized profit can come here also. No? Suppose same 20,000 is an unrealized profit in upstream case. In this case, who made the profit? Subsidiary. In working note number 4, anyway we are analyzing the reserves in surplus of subsidiary. So it will get considered in working note number 4. So if this is the case, means it will get considered in the working note number 4. That's what I've written here. Done now. But sir, in working note number 4, we have categorized pre and post. Usually all this transaction will happen after the control. These sort of transaction happens after control. Hence we reduce this or we eliminate this not under pre-acquisition profit but under post-acquisition. From post-acquisition profit, we will eliminate the unrealized profit. That's what I've written here. That's all you have to do. Okay. Something you told, huh? Okay. I think same unrealized profit, I've told it here. Okay, maybe since I've made so much mehanatto and put some numbers, so we will discuss this. Let's see how much you have paid attention. Okay, G. Okay, pay attention to this. H Limited has sold goods. Oh, it's the same, huh? Okay, no problem. H Limited has sold goods costing how much? 10,000. For how much value? 15,000. To which company? S Limited. And H has acquired 90% shares in S. Tell me first thing, what kind of a stream is this? Upstream, downstream, what stream? Downstream, because the holding company has sold the goods to subsidiary company. So it's a case of a downstream sale. Okay. Did H Limited make any profit through this transaction? Yes. How much? Cost was 10, no? Selling price was 15. So how much profit was made? 5,000 rupees. Any problem? Okay. Sir, for H it is selling price means for S Limited it is a cost price. Seller ka selling price is purchaser ka purchase price. So S Limited, what is the cost? For H Limited, if the selling price is 15 means for S Limited the cost is also 15,000. It's the same concept. Now, who has the goods? In whose godown or whose factory the goods are available? S Limited. The year has ended. The goods are lying in whose factory? S Limited. And S Limited is showing this closing stock at what value? 15,000. Yes, sir, people. But now we are preparing what? CFS, Consolidated Financial Statement. From CFS perspective, are you treating H separately, S separately, or together? Together, right? Inventory should be shown at selling price or cost price. Inventory should be valued at cost price or selling price? Cost price. From the group, CFS means group. From the group perspective, is the cost of the goods really 15 or is it just 10? 10. But currently subsidiary is showing it at 15. That means, is this acceptable or eliminate? Eliminate. Okay, now, so how much is the total profit? 5,000. How much is unrealized profit? 5. Why unrealized profit is 5,000? Because look at this case 1. 100% of the goods lying unsold with S Limited at year end. So, holding company sold goods to subsidiary company and 100% of the goods is still lying unsold as closing stock in whose factory? S factory. That means entire profit becomes unrealized profit, which can you show or eliminate? Eliminate. Who made the profit? Who made the profit here? H Limited. Tell me in which working note it will come. Working note number 7 you will eliminate this 5,000. Okay, Naji? Okay, people. Let's take the second case. Let's say 40% of the goods only is lying unsold. Possible, no? After purchasing the goods from H Limited, S can also sell the goods, right? So second case I have assumed S Limited purchased the goods from H, and in that goods 60% is already sold off. 60% is already sold off. So how much is remaining? Only 40% is remaining. Okay, Naji? Now you tell me how much is the total profit which H Limited made through this transaction? 10,000 worth of goods, they sold it for 15. So the total profit made is what? 5,000. But is entire 5,000 unrealized? No. Sir, S Limited has already sold how much percentage of the goods to outsiders? So 60%. That means, is this unrealized or realized? Realized. Yes or no? How much goods are still lying only unsold? 100% or only 40%? If only 40% is lying as inventory in S Limited ka books, you can't eliminate entire 5,000. You can eliminate only 40% of that. 5,000 ka 40%, which is how much? 2,000 rupees. Understood, everybody? So basically the concept is unrealized. If you're getting confused, one main easy concept to retrace this is unrealized profit means how much profit is included in the closing stock. How much profit is included in the closing stock. In the second, in first case, how much goods are lying as unsold? 1%, 2% or 100%? 100% of the goods is lying as closing stock. Hence, 100% of the profit you will eliminate. But in the second case, 100% of the goods S Limited has, or in that 60% they have already sold. In this, after this transaction, S has already sold how much? 60%. How much is the remaining? 40%. 40% remaining only we call it as what? Closing stock. So only how much ever profit is included in the closing stock that we need to eliminate. Hence in the second case only 40% we shall eliminate. Pakka ji? Pakka got it? Okay, suppose, okay, let's see how well you got it. Just clearly we will just discuss this. H Limited sold goods to S Limited, at same price. After purchasing the goods, listen to this carefully, after purchasing the goods, S Limited sold 100% of the goods to outsiders. What's the scenario? H sold it to whom? S, and made how much profit? 5,000. After purchasing the goods from holding company, what did the subsidiary company do? They sold off 100% of such goods to whom? To some random party. Now you tell me how much is unrealized profit? Nothing, zero. Why? Because any of this goods is lying as closing stock in S or 0%? 0%. If closing stock is 0% means unrealized profit is also 0%. So it's all a game about how much goods are still remaining unsold. First find that and accordingly eliminate. Okay, now some questions they will give this data, this adjustment in percentage. Some they will give it in fraction. ICA tests in both ways. Okay, you know the things. No, 1/4 of the goods is sold. 1/4 of the goods sold. 1/4 is sold means remaining is what? 3. Like that also they can ask. That way also they'll play around. Sometimes with percentage, sometimes with numbers, fractions like this also they will ask. Yeah, that's pretty much with respect to unrealized profit. Which working note, what to do. Anything more? You need any process? I'm giving you processing time because next question we'll be doing the same thing. If you have got it here, question is not really required. It is a pure applications. Move on to the next one. Okay, the next one is again an important adjustment, revaluation adjustment. Revaluation adjustment. Now people, come back to this working note number 6. Okay. Now, listen to this. When holding company purchases shares in subsidiary company, holding company will buy the shares at face value or market value? Market price. Yes or no? Yes. Whatever is the market price, holding company will pay that much and acquire the shares. Oh, done. Okay. Excuse me. No. Same example. I think I remember who was that owning building on Nungambakam. Some example we can. You are the one, no? What's your name? Prem. Prem only, no? Prem. I remember that some example we use, no? Let maybe continue the same only, right? So Prem is still owning a building in Nungambakam which he purchased 10 years back for how much? 25 lakh. And that you remember, kidney I tell you. Okay. Today its value has become 25 crore. So if today Prem sells that building or land, he will not sell it for 25 lakh, rather he'll sell it for 25 crores. Correct? Yes, that's absolute way. Same drama here also. Cost of investment is not represented on the face value, it is represented on the market value terms. Because when you buy the investment, if holding company wants to buy the investment, they have to pay market price. They have to pay market price. That means, can you take face value and do this goodwill calculation? Would that be right? Sir, since the cost of investment is expressed on what terms? Market value terms, what you'll have to do is, there will be certain assets whose book value and market value will not match. Whose book value and market value will not match. Let's say land example. Carrying amount of the, or maybe I'll not take land because of this. Let's take maybe plant and machinery. Sir, there is a plant and machinery of subsidiary company S Limited, which they are showing in their books, let's say at 1 lakh rupees. Subsidiary company is showing the asset in their books at how much value? 1 lakh. But the market value of that asset is 1,50,000. Okay. Now, when holding company purchases the shares, they will do the valuation. They'll have to do the valuation. No, it is not random thing. No, I will pay 1 lakh, give me. There will be a valuation. How will you value the company? Through their assets and liabilities. Yes or no? Assets and liability, you will consider it at book value or market value. So when the company ka valuation is done, you don't take book value, you take a market value. Keeping that in mind, investment price will be determined. Yes or no? Yes or no? No. Check this. I've taken one asset for simplicity purpose. Subsidiary company has one plant and machinery whose carrying amount is how much? 1 lakh. But their market value is 1,50,000. Okay. Now, when holding company got the control in subsidiary company, what value will be considered? 1 lakh, 1,50,000 to determine the price. To determine the investment value, will you take 1 lakh and value or 150 and value? 1,50,000 and value, correct? No? Yes. But is subsidiary company showing the asset at 150 or 1 lakh? So the cost of investment is on which platform? The cost of investment is on which platform? Market value, right? So if one component is on market value, another component is on face value, straight away is it comparable? To compare both of them, can you compare an apple and orange and say this is sweet, that is not sweet? Two apples you can compare and say one is sweeter than the other. Can you take two different fruits and compare? Are they comparable? No. That's what we should not do here. Alright. So now subsidiary company is showing the asset at what value in their books? 1 lakh, which is what? Book value or carrying amount. But the investment was based on carrying amount or market value? Yes, no? That means how much got ignored over here? Can you tell me? How much got ignored? 50,000 got ignored. This we can some books refer to this as fair value adjustments. Fair value adjustment. Because subsidiary company is showing the asset at what value? 1 lakh. But the investment value was determined by keeping what, sir? 1,50,000. So can we take this and compare, or should we take 150 for comparison purpose? 150. But subsidiary ka books does not have 150. It has what? 1. So take this value, take this 1 lakh and do something called what, sir? Fair value adjustment. So from 1 lakh, how do you get 150? From 1 lakh, how do you get 150? Add 50,000. This is what we mean by adding fair value. Yes, sir. Akka got it, everybody. Or if I have to say in another way, for simplicity purpose. Asset ka value is just another approach. Asset ka subsidiary ka, this asset ka value is how much? Book value is how much? 1 lakh. Market value how much? 1,50,000. Sad face or happy face? If an asset value is increasing, that is sad or happy now? Happy face. How much happy face? If you remember, if an asset ka value increases, we call it as revaluation reserve. Accounting standard 10 and all you guys have done. No da. If an asset ka value increases, we put it in revaluation reserve. Revaluation reserve is also a reserve. Revaluation reserve is also a reserve. This is relating to holding company or subsidiary company? Subsidiary company. I mean, this should be ignored or considered? Where? We have 7 working notes now. Where will you consider this 50? Tell me. Make me happy. Make me happy. Working note number 1, shareholding percentage, not relevant. Second to general reserve, not relevant. Third is P&L, not relevant. Fourth one. Analysis of reserves and surplus of subsidiary company. Through this adjustment, we got an extra reserve called revaluation reserve to the extent of 50. Yes, sir. So that means this should be considered where? Now you tell me. This should be considered where? I think I've written somewhere. It should be considered under working note number 4. Yes, sir. But there is one more drama. What is that one more drama? In working note number 4, we have a category now. Prina Posta. Prina Posta. You tell me. Prina Posta. Prina Posta. Priya. Why Pri? Perfect. Sir. When are you doing this exercise? This exercise, or maybe let me tell you this. You do this exercise, all this activity, you do it on the day holding company got control. On the day holding company got control in subsidiary company, that day you do all this activity. This asset came on that day or it was there much before? All these assets came after holding company became shareholder, or all these are already existing? Already existing means it is post or pre. That means this should come under working note number 4 under what, sir? Pre-adjustment. One more adjustment. Got it? Pakana. What will come? 50,000. Because subsidiary has considered 1 lakh, but for consolidation purpose, what has got ignored? 50. So consider that 50,000. 1 lakh already considered. Consider 15 now. So it becomes how much? 1 lakh 50. That is a market value and investment is based on market value. So reasonable comparison. Done, Aji? Yes, sir. Okay. Sir, is it necessary? It has to be. This is a case of what? Increase or decrease? That's what I've written here. First is a case of what? Revaluation increase. Because 1 lakh has become 1,50,000. So this is a case of revaluation increase. So if there is an increase amount, where you will consider again? Tell me. Working note number 4. Under what? Pre-acquisition profit scenario. Is it necessary every time it has to be happy face, or Prem also can suffer? Not that we wish him to suffer, but it could be a possibility that he bought the building at 25 lakh and our Tamil Nadu government told, I will build a flyover on your land. Possible? No. Sometimes the value can also reduce. So this was an example of revaluation increase. The opposite is what? Revaluation reduce. Sir, if it is revaluation increase, you will show this as what number? You will show it as a positive number. Because we are not preparing any ledger account. We are preparing statements. In statement, there is only positive, negative. Positive, negative. So increase is shown as a positive. because they have considered 1. We have to consider how much? 150. From 1, if you have to reach to 150, we have to minus up, we have to add. So in first case, you will add. Suppose it's a case of revaluation decrease. Revaluation decrease. Meaning, let us say the carrying amount is 50,000, market value is only people 15,000. That means go in the how much? 35,000. This is a case of revaluation increase or revaluation reduction. Subsidiary company has considered how much in their books? 50. But for consolidation purpose, we have to consider 15. So from 50, how do you get to 15? By adding 35 or reducing 35? Reducing 35. So this 35 will be shown as what? Positive number or a negative number? Where? Working note number 4. Post or pre-now? Important adjustment, usually seen in most of the exam questions. Sir, when I say important, it does not mean that it will come. It means that it has come a lot of times. It may come in your attempt. If it comes, awesome. If it doesn't come, don't blame me. We have covered every type of question, right? What examiner picks is their headache. Our headache is to cover. Now, our headache is to probably revise, at least to the extent possible. Till you are okay, G, or you need some time to collate anything? Nothing to collate. Sir, this particular adjustment will bring in one more headache. This will bring in one more headache. What is that? Depreciation. What is this? Check. Ikkada chudandi. Screen chudandi. Sir. Subsidiary company. Let's take this first case. Subsidiary company has taken carrying amount as what? In subsidiary company books, they have considered value as what? 1 lakh. Now means subsidiary company has calculated depreciation on what? 1 lakh. Yes, sir. Are they wrong or are they perfect in that? They're right. They're not done any mistake. But for consolidation purpose, are we considering 1 or are we taking 150? 150, because investment is not based on the carrying amount, it is based on the margin. Right? No. So subsidiary has calculated the depreciation in this asset on 1 lakh. But for consolidation purpose, should we depreciate on 1 lakh or 150? If you're considering its value as 150 for consolidation, then depreciation also should be on 150. But subsidiary has done it only on 1 lakh. Let's say depreciation rate is 10%. So calculate, how much have they depreciated? Subsidiary has calculated the depreciation as 1 lakh or 10%, which is how much? 10,000. But for consolidation purpose, 1 now, 150. So how much depreciation should have been accounted? So subsidiary company charged more depreciation or less depreciation? In this case, subsidiary charged how much? 10. How much should have been charged for consolidation purpose? 15. So how much did not get charged? Is it a mistake or this is all CFS adjustments? These are all consolidation adjustment. No, nothing wrong here. Subsidiary has not done any mistake. It is only a pure consolidation adjustment. Subsidiary considered 10,000, but for consolidation purpose, we have to consider 15. So how much extra depreciation we need to account now in where? In CFS. How much? 5,000. Done now? Yes, sir. Now depreciation is an expense. If an expense increases or if we have to increase an expense, what will happen to profit? If an expense increases means profit will. That means this 5,000 or due to this 5,000 subsidiary ka profit will have to be increased or it will have to be reduced. It will have to be reduced. Done now? All that adjustment is happening through working note number 4. Because all this analysis we are doing in working note number 4. But headache still remains. Pre-now, post-now. Pre-now, post-now. What do you think? This 5,000 where it will come? Pre-now, post-now. Do both. Pre and post you do. But sir, usually, one way it's right only, alright. But the thought process here is simplistic adjustment is we usually charge depreciation at the end of the year, right? So the treatment they have suggested is reduce it from post-acquisition profit. So this 5,000, you reduce it from where? Under working note number 4 as post-acquisition profit. Simplistic treatment. Not that your idea is wrong, but this is just the way they've looked at the things. Done, Aji. That's what I've written here, Chi. In case asset value increases, if in case asset value increases, there will be two adjustments. What are those two adjustments? One revaluation reserve will come for, in this example, 50,000. Where it will come? Where will this 50,000 come? In working note number 4 under pre as a negative or positive number? Positive number. Due to the same adjustment, there will be another related adjustment called extra depreciation, which subsidiary has not charged, but we need to charge it for consolidation purpose. So how much is that extra depreciation? When you have to account an extra depreciation, profit will reduce. Hence, you have to make this as a positive adjustment or negative adjustment. And usually depreciation is charged at the end of the year. Hence, we don't put this under post, or rather we don't put it under pre, but rather show it under post. Same thing I've called out here. Done. I mean, this adjustment will have, just if you want it as a formula, if you feel too much, you can simply say if asset value is increased, under pre may you add, under post may you minus. Okay. Revaluation decrease happens means ulta. Under pre may you minus, under post may you add. Okay. Just at least know the value. Don't add and minus the same value, Guru. Eh? All right. This is the asset value increase. This is the depreciation value. Calculate the value, and then at least if you want to mug it up as formula and keep it, do it. Because sometimes, no, last minute we can't remember everything. So we will be like, it's okay, give us some formula, we will mug it up and somehow we'll do something. So if that you want means this is the solution. Whichever way. Ideally, I don't prefer those mug up approach, but whatever works for you, it's okay. But at the end of the day, give me good news. Yeah, clear. Yeah, that's all we are all looking for here at the end of the day as faculties. Yes, your results don't know how much happiness you can bring in our like it will definitely have. I mean, let's not go there. It'll another 10-15 minutes will go off if I speak extracurricular activity. Then so you literally start throwing things only at me, I think. Because some of you might already be counting 1:30. You told it's already 1:30. You leave. No, yeah. What? Huh? 1:30. You want to go? No. We'll sit alarm say 2:30, 3 o'clock. You have Nungambakam building, no? Why are you worrying? You aram se chill. We will chill. Fasting class. Fasting class, Rashtrath, you adjust. Rashtrath also half an hour, he'll be tired. He's also taking from morning. No, he'll also be a little tired. You tell him 15 minutes, you break. Sorry, he's like you. When we get tired, you also take break. Done, pa. Okay, at least let's finish the concept. Concept is overall okay? Okay, so these are some usually adjustments which comes. There's one more. I think this one I will tell. Okay, this one I'll just tell it as a formula. Then when the question comes, maybe if you want the logic, I'll tell you. Sir, when subsidiary company declares dividend, what did I say? When subsidiary company declares the dividend, first find whether it is a normal dividend or pre-acquisition dividend. You know the identification. How? If dividend, if it is relating to the previous year. Previous year was holding company a shareholder or not a shareholder? So means logically, should holding company get this dividend or they should not? They should. But practically, will they get it? Yes. I mean, such a dividend becomes what? Pre-acquisition dividend. All right. So, and if it's a normal dividend, then you know the entry, right? Normal dividend, what is the entry? Bank to dividend income, and dividend income you transfer it to P&L. If it is pre-acquisition dividend, if some of you, if you wanted as formula, I used to tell this in classes, someone is laughing. give sir, formula only we need. Logic and all, leave now. Pre-acquisition dividend, if it is there. Simple formula, reduce it from 3, 4, 6. Reduce pre-acquisition dividend from working note number 3, 4, 6 and 7. That's formula. Why? Maybe I'll tell you when I go to the one question. If you want to know, I will tell you. But this is a formula. I've written it here. That also works. Okay, now, but one way or the other, remember. I'll tell you why we do this. Let's do a thing. And this is common concept. I think with this, all the concepts are over. We can go into the question. You know, mutual owings, MO. What was mutual owings in amalgamation context? A transaction happening between a purchasing company and a selling company. Right? Here also same only, but here transaction is happening between a holding company and a. Sir, as long as holding company is a separate legal entity, subsidiary is a separate legal entity, one can sell the goods to other, provide service and all that. But for consolidation purpose, are you treating them as separate or are you treating them as one? You're treating them as one. So, if H Limited has sold goods to S Limited and if H Limited is showing it as a debtor, S Limited will show it as a creditor. Same component in consolidated financial statement, can you show both as an asset as well as a liability? Both as a debtor, as a creditor. Same component can you show? No. Right? So, hence what we have to do? That is your mutual owings which you need to eliminate. And you know mutual owings can come in three forms. What are those? Same. Debtor, creditor, bill receivable, bills payable, loan taken. You don't have to pass any entry here. Just eliminate them from balance sheet. When you prepare consolidated balance sheet, from debtors also you eliminate, from creditors also you eliminate, from bill receivable also eliminate, bills payable also eliminate. Usually loans they don't give, but these BR, BP, debtor, creditor is what usually gets asked. That's the same drama, no change. Okay now people, let's do a thing. We'll take about 5 minutes and recap whatever we have discussed and then we'll dive into the questions. Give me like 1 minute. After 4 hours now, our throat also will be like, it also needs a break. But unfortunately, I can't take that break now. Another 4-5 days, I will also adjust along with you. Yes, people. Chapter name, Consolidated Financial Statements. Which consolidation are we talking about? Holding, subsidiary. Which accounting standard? AS 21. Perfect. Now, if you want to apply AS 21 ka provision, we look for one key component called control. How do you get control? If holding company owns more than 50% shares in subsidiary company, then only we say there is control. If control comes, AS 21 gets triggered or gets applicable. Fine, this one you leave it. Then as I said, consolidation problems we work out in certain working notes, 7 working notes. First working note, shareholding percentage, meaning holding company owns how much shares in subsidiary, minority interest owns how much shares in subsidiary. Finding out that is working note number 1. Working note number 2, general reserve of subsidiary company. Third one, P&L account of subsidiary company. In fourth one, all the reserves and surplus of subsidiary company first gets categorized into pre and post. Pre-acquisition and post-acquisition. Pre-acquisition means before holding company became shareholder, how much subsidiary company had as reserves and surplus. That is a pre-element. Those reserves and surplus which came after holding company became a shareholder, we call it as post-acquisition. This, whether it is pre or whether it is post, we allocate among whom? Shareholders. The shareholders of subsidiary company are 2 people, holding and minority interest. Do that allocation in shareholding percentage. And working note number 5, minority interest. Minority interest is a shareholder. Shareholder asks for 3 things. Their share of share capital and their share of reserves and surplus. But the reserves and surplus of subsidiary company is now split into pre and post. So to get minority, we consider 3 things. Their share of share capital, their share of pre-acquisition profit, their share of post. Then working note number 6. This is where we calculate goodwill or capital reserve. Take the cost of investment expressed on what term? Face value or market value? Market value. Then reduce pre-acquisition dividend. Because ideally you should not get it, but reality you are getting it. So hence net it off from or adjust it from the cost of investment. Same goes for pre-acquisition, reserves and surplus or profits also, net it off. By doing this, you will get the net cost of investment. Compare it with face value share capital. Then if you get a higher number, positive number goodwill, negative number leads to capital reserve. Then working note number 7 is where you show the consolidated reserves which will come in your consolidated balance sheet. First take the holding company ka reserves and surplus as it is. Whatever is given, list it out. If you have got any capital reserve here, add them. Then subsidiary company ka reserves and surplus has got segregated into various parts. Pre, post. And under pre, minority ka, under post, minority ka is already considered. Holding company ka pre-acquisition profit also is considered under working note number 6. The only thing missed out is what? holding company ka their share of post acquisition profit that gets considered there. And unrealized profit you need to eliminate. Unrealized profit means total profit or profit included in closing stock. Profit included in closing stock. If every unrealized profit gets eliminated from working note number 7, no. It depends on whether it is an upstream sale or a downstream sale. If it's a downstream sale, if the arrow is going down, that means holding has sold the goods to subsidiary. So who made the profit? Holding. Holding company, if they make the profit, means it comes under working note number 7. Fine. If subsidiary, if it's an upstream, subsidiary has sold goods to parent means arrow is going up. So it's an upstream sale. In that case, who made profit? Subsidiary. And subsidiary ka profit gets analyzed in which working note? Working note number 4. So there it gets eliminated. Okay. I think that's pretty much it. And pre-acquisition dividend also, I've said that you need to eliminate that. Yes, sir. This one I think I've not explained. It's okay. Maybe one problem we will do. Remind me about this. I'll tell you about this. And I think probably one last adjustment I think we discussed is also on the revaluation increase or revaluation decrease. Usually 1 or 2 assets they will give which will have some revaluation adjustment. What is this concept of revaluation? Investment is expressed on market value terms. Right? That means for consolidation purpose, investment ka value is taken on market value terms. But subsidiary is showing all their assets in their books at what value? Carrying. But the market value and carrying amount, should it compulsorily match or there may be a mismatch? There may be a mismatch like this. Carrying amount can be 1 lakh, market value can be 1 lakh 50,000. Subsidiary has considered 1 lakh for accounting, but for CFS purpose, we need to consider 1 lakh 50,000. So how much has got ignored for consolidation purpose? 50,000. That we refer to as what? Fair value adjustments. This is a case of revaluation. Revaluation. Sad or happy face? Happy face. So means where will this come? Asset was already existing. So it should come under post or pre. Under pre-acquisition profit, consider this as a revaluation adjustment or revaluation reserve, whatever. Okay. Only this or there will be another corresponding adjustment. Subsidiary company has depreciated this asset at 1 lakh. But for consolidation purpose, we should consider 150. So how much depre has not been considered by subsidiary? 5,000. Ignore or for CFS purpose, now consider. Now consider. When will you charge depreciation? On the date of control or at the end of the year? End of the year. I mean, this should come under pre or post. This will come under working note number 4 under post. Because of this depreciation, profit will increase or reduce? Reduce. Hence, this adjustment you'll have to show it as a negative number. The ulta of this is your revaluation decrease. Yeah. And then I think what? That's it. I think pre-acquisition dividend, I gave you a formula 3, 4, 6 and 7. No, mutual owings is the same component. In consolidated balance sheet, eliminate from the respective places. Okay. I think now we are good to take up one question we will try, which will have some adjustments. And then we will see about this. First, I'll take up this because this is more popularly asked. Bonus is not that frequently asked. Revaluation to pakka they will ask. So I would like to probably focus on this. This is again a study material question. Can I start to? Okay. Pay attention. I'll keep asking you where it will go. You will have to guide me here. Okay. Don't worry. We don't have to solve. We can just review it. I think I have the things with me here. Yeah, I do have. Excuse me. From the reading the question is quite important. Though the question may look a little small, solution of consolidation will always be on the lengthier side because of the number of working notes we need to prepare. From the following balance sheet of H Limited and its subsidiary S Limited drawn up to 31st March 20 X1. So current year is ending on 31st March 20 X1. So what is the whole of current year? If it is ending on X1, it will start from X0. So this is our current year. Is that okay? Moving on. You just need to prepare consolidated balance sheet on the same day, but you'll have to consider some few informations one by one. Read this. Reserves and P&L account of S Limited. Reserves and P&L account of S Limited stood at 25,000 and 15,000 respectively on the date of acquisition of 80% shares by H Limited on 1st April 20 X0. Sir, our current year is beginning on this date. When did H Limited acquire the shares of subsidiary company? H Limited acquired the shares also on 1st April 20 X0. Yes, sir. Pakana. Okay, so this can I say is DOC? DOC as in date of control. Or you can also call it as DOA also, date of acquisition. Both are fine. So this is the date on which holding company got the control over subsidiary company. Good. Working note number 1, I have to prepare or sorted. What is working note number 1? Shareholding percentage. We have to find or given. H has 80%. They have only given. Just for the sake of solving, I've just put it here. First working notice, H has 80%. So that means minority will have the balance 20%. So this was essentially given. So if you want, you could have actually cut off this working note also, no big deal. Sorted. Now people, excuse me. Year is beginning on 1st April 20x0. On this particular day, they have given you reserve ka and P&L account of subsidiary ka balance. So what is it? On this day, whatever balance you have, that only we call it as opening balance. Yes sir? Or you can also call it as pre-acquisition. Because on the date of control, these two were already existing. I'll maybe take that in a bit because I'm going in the steps. What is working note number 2 we discussed? General reserve. Do you know general reserve ka opening balance? Check this. Reserve of subsidiary company ka opening balance is how much? 25,000. Tell me the ledger. Visualize the ledger and tell me reserve ka opening balance. Where will you post? On the debit side or a credit side? Credit side. You will post it as what? Opening balance. No. So buy balance brought down 25,000. Is that clear? You will post this. Okay. Now people, this is the balance. 25,000 is a balance as on which day? On the first day of the year. What is the year ending date? 31st March 20x1. If you just check here, they have already given H limited ka, S limited ka, individual balance sheet. Look at the date. 31st March 20x1. 31st March 20x1 is opening balance or closing balance? End of the year balance. No? So now check. They prepared note number 2 for reserves in surplus. Go to that note number 2. This is HO, this is SO. What is S limited ka general reserve balance? 75,000. What is the 75,000? Closing. Because this is the balance at the end of the year. Where will it come? In your ledger, it will come on the debit side as 2 balance carried down 75,000. Yes, no people. Opening was given. Closing was given. Done. Now use your common sense. Opening balance of general reserve was how much? 25. Closing has become general reserve from 25. Suddenly it has become 75. It has increased from 25. It has become 75 means it has increased by how much? So something should come on the credit side of general reserve as 50,000. Yes. Sir, you don't do any transaction with general reserve, right? General reserve can only increase provided you transfer some balance from P&L to general reserve. That is the only possible case where general reserve balance can increase. Yes or no? What is this 50,000? This 50,000 is nothing but the amount transferred from P&L to general reserve. So the posting here will be what? By P&L, calculated or balancing figure? Balancing figure. This ledger is pending or fully closed? Fully closed. Usually these two will be given to you in the question. This you will have to get it as a balancing figure. That will be same. That is the amount to be transferred or amount transferred from P&L to general reserve. Now what we did for general reserve, same thing we'll have to do it for P&L. So working note number 3 is that P&L account of the subsidiary company which is S Limited. Go back to that adjustment. Do you know P&L ka opening balance? Yeah. On 1st April 20x0, they are saying P&L ka balance is 15,000 given. Have they told P&L has debit balance? Sir, if they say P&L balance is 15,000, always assume that it is a profit making company. Don't assume that it is loss making. If it is loss making, clearly they will mention that P&L had a debit balance of so and so. They'll mention. If nothing is mentioned, it is always profit. How much is opening balance of P&L? 15. Where will you post this? Same like, no, in the ledger I'm talking about. In the ledger, it will come on the debit side or credit side? Credit side. Same like this, working note number 2, working note number 3 on the same parlance. Buy balance brought down 15,000. Yes, sir, Ji. They have already given balance sheet of subsidiary company at the beginning of the year or end of the year? End of the year balance sheet will have opening balance or closing balance? So if you come to note number 2, P&L of subsidiary company has a balance of how much? 25,000. What is this? Closing balance of P&L. Where will you show this in the ledger? Debit side or credit side? Debit side. As what? To balance carried down 25,000. So this one we have ticked, this one we have ticked. Yes, sir. Did you transfer anything from P&L to general reserve? Yeah. What did you post here as? In general reserve ledger, you posted it as by P&L. So what is the entry here effectively? What is the entry here effectively? P&L account debit to general reserve. So same, you'll have to post it in P&L ledger also. You will post it as what? To general reserve 50,000. Same 50,000 you posted. Easy na ji? Correct Aji? Okay, the simple question we don't have, not that simple also, but we don't have any pre-acquisition dividend over here. There's no other adjustment, so I can close out here. Now check this screen, everyone. Opening balance was how much, sir? 50. Okay, now look at the thing. Opening balance was only 50. No? From using 50, you transferred how much to general reserve? 50, and you're still left with 25. Possible, huh? Sir, you have only 15 means how can you transfer 50,000 and still remain with how much? 25. Is that a possible scenario? No. That means what? These two are only possible because this 15,000 is current year profit or opening balance of profit. Opening balance of profit. If you just check, ledger is not matching. This side total is how much? 75. This side also should be 75. So something should come here for the balancing figure. How much? 60,000. What is that? Current year profit. So to get this particular component, we prepare working note number 2 and working note number 3. Because there will be some transfers from P&L to general reserve. Transfer will affect working note number 3. And using that, we will get current year profit as a balancing figure. Through this, we'll have to do some calculations. So this is not a calculated number. It is just a balancing figure. 3 working notes we are done. Wait, next one. Anji, 2 minutes break you wanted, huh? You take that. But numbers are okay, no, overall. So what we have put in, that's okay, right? All right, guide me through. Next is what? Working note number 4. What do we do in working note number 4? Analysis of reserves and surplus of which company? Subsidiary company. First, the categorize. What is that categorization? Pre and post. And then the distribution. Distribution will be among whom? Holding company, minority. In what ratio? Shareholding percentage, which we have got it in working note number 1 as 80 and 20. Yes, sir, people. Now, how do we do this? Line by line item, we will go. All the adjustments we shall consider on a line by line item basis. Okay, that's how we prepare working note number 4 analysis. Line by line item, what do I mean by this? Okay, which is the first reserve you are able to see? General reserve. Under that first component is what? Opening balance. Sir, holding company, when did they acquire the shares in subsidiary? On the first day. On the first day, subsidiary already had 25,000 general reserve. I mean, this is post or pre. So this 25,000 should come under post column or pre column? Pre column. So first, when you make this working out, you'll anyway have to distribute the reserve among holding and minority interest. But before you distribute, you'll have to categorize the reserve as what? Pre-acquisition profit and post-acquisition profit. So each individual line item, you'll have to go on allocating under pre-post like that. Okay, one by one, you'll have to go on. Now this 25,000, this particular 25,000, it was already existing because it is opening balance. So this should come under post or pre now. Pre. So under the total, how much is this total? 25,000. 25,000, put it under the total column and allocate. This is whose company ka general reserve opening balance? Subsidiary. And subsidiary ka reserve will get distributed among whom? Holding and minority. In this problem, in which ratio? 80 and 20. 25,000 into 80% if you do, you will get 20. 25,000 ka 20% if you do, you will get 5. Done. Sir, if it is profit, you show it as a positive apportionment. If it's an expense or if it is a loss or if it is reducing profit, we show it as a negative apportionment because it's not a ledger, it is a statement. In statement where there can only be a positive and a negative number. Like this line by line item will have to go. Okay, Naji? This is sorted out. This 50,000, has it come from general reserve or it's come from P&L? P&L. Anyway, P&L also we're going to do this distribution. So should we have to worry about this 50 or not required? No, not required, because this 50 came from P&L only, because P&L also we shall distribute in a while. So hence, general reserve ka everything is sorted. Do you agree? Because this 25 plus this 50, these two if you consider means, then only you will get 75. No, none no people. So this is sorted. Next, same drama. Help me out here. P&L ka one by one. First, target the credit items and tell me one by one. I think I would like you to take one of the initiative here. What should I do for this? 15,000 is what? 15,000 is opening balance. That means this holding company acquired the shares on the first day. On the first day, subsidiary already had 15,000 P&L balance. I mean, this is post or pre? Loss of profit. Profit. So negative apportionment or positive? So that's what I've written here. Opening balance of P&L. How much value? 15,000. This 15,000 you distribute among 80-20 ratio, you will get this particular number. Okay, Naji? Yes, sir. All right, let's move on to the next one. 60,000. 60,000. What is that 60,000? Current year ka profit. Calculated or balancing figure. When we prepared the ledger, we got it as a balancing figure. In this problem, it is very straightforward. Why? Entire 60,000 is post. How can I tell? Sir, holding company acquired the shares on the very first day. That means entire profit came after holding company became shareholder in subsidiary company. This entire 60,000 profit was generated only after holding company became the shareholder. So it is not pre, it is definitely post. Do you agree? So that means this 60,000 should come under pre column or post column. So under post column, I've written here, check current year profit, how much? 60,000. And this 60 also gets allocated among holding and minority in the ratio of 80 and 20. So 48 and 12,000 would be the apportionment. This one done, this one done. Agreed? Go back to the other one. Sir, this general reserve, how much you transferred to general reserve? 50,000. This is pointless apportionment. Why? Sir, to transfer money, to transfer component to general reserve, right, you need to have balance. Either this 50,000 transfer has come through opening balance or it has come through current year profit. Yes, no? Yes, no, people? Or maybe you can think of it this way only. Out of 60,000 current year profit, how much did you transfer to general reserve? 50. 60,000 is anyway allocated, no? So we don't have to do any separate adjustment for this. Or if you want to adjust it, there is one way to adjust it in case. Okay. Now you transferred how much from P&L to general reserve? 50,000. So because of this, P&L balance reduced. If reserve balance reduces, it is a positive apportionment or negative apportionment? Negative apportionment. So you give 50,000 as what here? Positive or negative apportionment? You give it as a negative apportionment. Correct? Yes. But there is another corresponding also. General reserve increased. General reserve increased. If general reserve increases, then it is a negative or positive apportionment? I mean, effectively what you're doing, 50,000 you are giving first as a negative apportionment. Same 50,000 again you are giving it as a positive apportionment required. Hence we have ignored. Okay, Naji. If you want that way, you can present, nothing wrong, but interest of time not required is what I feel. Wait, carry on. These two done now. In this problem, pre-acquisition dividend is not there. Remind me once, I'll talk about that 3, 4, 6, 7 adjustment. Why do we do that? Let me finish this problem first. Okay, done. Next, people. Sir, this 25,000, is it an arrived number or a derived number? Sir, how did you get 25 basically? You had 15,000. In that, additionally, how much profit you made? 60. So take a calculator. You had 15, you generated 60 more. How much you have? 75. In that 75, you transferred how much? 50,000 to general reserve. Correct? No. So if these three are already considered, means this one should be considered, or it's anyway balancing figure. Balancing figure. So should we have to distribute this or not required? Not required, because this came as a remaining number. We did not generate any extra profit here. Understood? No? So if you have allocated this, that means this also indirectly has got allocated is the idea. Carry on. Okay, fine. This is sorted. Oh, come back to the question now. There could be one or two adjustments, your favorite adjustments. Read this, help me out. I think when I read it, you should be able to decode this for me. Machinery. You know, the moment you read asset, you know what adjustment is this. What adjustment? Revaluation increase or maybe revaluation decrease. So see, machinery, book value is how much? 1 lakh. There is also furniture, book value as in carrying amount. How much is that? 20,000. So they have given not one asset but two assets ka maybe revaluation data. This is of which company? S Limited. But they were revalued. They were revalued at what? 1,50,000 and 15,000 respectively on 1st April. Because you do all this revaluation on the date of control. Okay. So now again check. Furniture ka book value or carrying amount is how much? 1 lakh. But the revalued amount is 1,50,000. Sad face or happy face? Happy face. How much happy face? 50,000. Where will this happy face get captured here? Working note number 4. If you're confused, you can simply think of it as a revaluation reserve. Revaluation reserve. Where will revaluation reserve come? Under working note number 4. This asset came after holding company became shareholder or it's already existing? Already existing. Correct. And all this revaluation got done on which date? 1st April. That means this revaluation increase you should put under pre or post. Book value is 1 lakh, market value is 1,50,000. So it's a revaluation gain, or you can call it as fair value adjustment. Post or pre now? Pre. So under working note number 4, same working note number 4 mein under pre-acquisition profit, you will show revaluation adjustment on machinery. You can give any name, fair value adjustment also you can say. This is a loss or this is a gain? Gain. How gain? Market value was 150, book value is only 1 lakh. So how much is the increase? 50,000. Sir, if it's increase means negative. If a reserve is increasing means negative apportionment or a positive apportionment? Positive. So 50,000 you allocate among 80-20 ratio. It will be what? 40 and 10. Yes, sir, G. Okay. Only this adjustment or one more? This will have a corresponding one more adjustment. What is that? Depreciation. How? Sir, subsidiary company has depreciated their assets considering what value? 1 lakh. But for consolidation purpose, we are considering 1 lakh or 1,50,000. And look at the depreciation rate they have given. Machinery ka depre rate is what? 10%. So calculate. Subsidiary company, they have depreciated the asset on 1st April, or rather they have depreciated the asset on 1 lakh. So 1 lakh ka 10%, they have depreciated to the extent of 10,000. But for consolidation purpose, we are not taking 1 lakh, we are taking a market value of 1,50,000. So how much depreciation should have been charged? 1,50,000 ka 10%, which is 15,000. Subsidiary accounted this, but for consolidation purpose, we should consider 15. How much depreciation got missed out? Is it a mistake or consolidation adjustment? Consolidation adjustment. How much depreciation we have not charged? 5,000. Yes, Ajay. So that 5,000 ignore or consider? Consider. Where? Pre na post na? Post. Why? The idea here is we are charging depreciation at the end of the year. The end of the year activity becomes post. Due to, if you book one extra depreciation, if you account one extra depreciation, your profit balance will increase or it will reduce. And an item which is causing a reduction in reserves, we show it as a positive apportionment or as a negative apportionment? Negative. So this 5,000 in your working note number 4, where you should put it under? Post. As a positive or as a negative? Negative. How much value? 5,000. That's what I've done here. 5,000 negative apportionment. This also gets distributed to holding and minority in 80-20 ratio. Each component, you go line by line item and distribute. That's pretty much, huh? What's your name, da? Ashik. Ashik is saying, suppose the date of control is not year beginning, it is year midway, after 6 months. Then you will have to account excess depreciation only for 6 months. So from the date of control till the end of the year. That question is also there. 2-3 years there in our materials. Right now I'm discussing concept. We don't want to bring full locha now. One only with so much difficulty, people are wide awake watching. Now if you bring in this, then they'll be like, only. So that's what I'm saying. Use this as a base and build upon. Okay, there it is valid point only. In that case, excess depreciation will not be for whole year. It will be only for 6 months. Correct. She's saying, sir, what if the acquisition happened on the last day? Then no excess depreciation. Perfect. Then only this will come. Revaluation gain or revaluation loss. Excess depre or reversal will not, that case will not come into picture at all. Carry on. For everything they're saying yes only. All right. Now, sir, there's. So, what's your name, Macha? Siddharth. Siddharth is saying, what if we don't do revaluation? One, sir, you'll be violating standard. What you are covering is little. More of this you'll study in Ind AS 103 business combination. CA final. Okay. The main idea is just 2 minutes. Since he's asked, I'm addressing. It's not relevant for others. You can leave it out if you want. See, the whole idea is when you compare and get goodwill or capital reserve, the number should be comparable. If one is on market value, if another is on book value, can you straight away compare them? No, it will be apple to orange comparison. So that is not acceptable. But I'll take your point that, sir, revaluation may be practically difficult because we will not have one asset, we will have hundreds and thousands of assets. For that, Ind AS 103 has some measurement period concept. They give you 1 year time. So, yeah, temporarily you find one value, account goodwill. I'll give you 1 year time. If you want, you can do revaluation further and revise goodwill. Not inter syllabus, final syllabus. Not required. Okay, na? No, he said revaluation was not a possibility. That's what he said. That was his question. That is not a possibility. Revaluation done at the middle of the year, as I said, 6 months depreciation. That is fine. Okay, Nada? You'll learn. 1 year. No worry, we'll catch up there. Not now. Or if you really want to know, watch CA final ka Ind AS 103 marathon. Yeah, that is okay. That is there. You can watch that. Not recommended though. Fine, sir. Come back to this now. Furniture. Furniture ka book value how much, sir? 20,000. Revalued how much, sir? 15,000. Happiness, sad face. Sad. 20 has become 15. So revaluation decrease. Help me out. What you will do? What you will do? Where you will put? And in which working note? Working note number 4. Under, pre, as, positive or negative? Negative. How much? 5,000. Perfect. Under, pre, revaluation loss 5,000 negative. Okay, Naji? Sir, for this, so depreciation you give it as a negative number, means for the other one you will give it as a positive number. Easy, no? Instead of going to logic sum, you can do simply sign reversal. And calculation is also very straightforward here. Check. Subsidiary company on furniture. Subsidiary company, where is it? Somewhere it went off. I don't know. Okay, maybe directly we'll do it over here. Sir, subsidiary company on their machinery, they've charged depreciation on what? 20,000. But for consolidation purpose, we are only considering 15,000. If you want, you can calculate also. Subsidiary has calculated depreciation on 20,000. And what is the rate of depreciation on furniture? Here given. How much? 15%. So 15 to 30. So this is 3,000. This is what subsidiary has charged in their books. But for consolidation purpose, are we considering the value of 20,000 or are we considering market value? For consolidation purpose, we have to consider market value of how much? 15,000. That means for consolidation purpose, we have to account depreciation or we have to calculate depreciation on 15,000. 15 ka 15%. How much is this? 2,250. No. Tell me. Subsidiary has charged less depreciation or they have charged more? They have charged 3,000. But for consolidation purpose, we have to charge only 2,250. How much extra they have already charged? 750. Now we have to charge this or reverse this? Reverse. Mistake or consolidation adjustment? Not a mistake. Purely consolidation adjustment. All are market value down. Done now. Sir, when you account depreciation, when you book an expense, when you account an expense, profit will reduce. Here you are booking an expense or reversing an expense. When you reverse an expense, profit balance will increase. So this you should show it as negative or positive? Positive. When will you charge depre? End of the year. So where it should come? Post. Under post as a negative number or a positive number? 750 should come under post too as a positive number and distribute. First update everything in the total column and then do the apportionment so that you will not get any mistake. Some students are directly in Josh they'll write off in minority interest column. That's happened, happens, and 0 marks because every ledger, every working note is interconnected. So hence, if you want to play it safe, first always update what column? Total column. Then go on distributing, so that way mistakes can be avoided. So that these and all know people, this creative mistakes and all we will not know. Your creativity you will only know. And if you want to know it, write 1 or 2 mock papers. You will know it. That's the reason we say write 1 or 2 mock papers. Common mistakes you can identify and try to cut down, because we have seen so many students getting 37, 38, 39, 149. That person will not be in this loka only for few days. He'll be like, yeah, 150. I've seen, yeah, few people 149, sir. How painful it should be. I've seen so many, and I think someone had sent me their mask card, I mean the result card, 148. Missed exemption also by 1 mark, 59. Their exemption also gone. Your group also not clearing. See, he already has one. It happened to you. Oh, 150 failed. Oh, because of taxation 34. Oh, all these are difficult. Yeah, but the sad reality of our CA examination. Our mother body is like, come again. No compromise. Not being harsh. It is just that, like, sir, CA has that credibility in the market. So unless they bring in all the stringent measures, then everybody will start clearing without putting efforts. Then the whole profession will come down. So they want to maintain a certain standards. But one good thing for you people is, the opportunities, crazy opportunities are coming outside India, which was not the case when I qualified or when we qualified. I'm talking about 2012. 12 is when I qualified, almost like 14, 15 years back, right? That time, if we had to travel abroad, we had to get another course. These days, since you study IFRS in your CA final, and many countries have adopted IFRS, straight away they take you. So opportunities are good. And another good thing is foundation. The recent trend is foundation and inter students are finding it difficult to crack. Final, I say is also you go, no problem. Because anyway, their idea is probably will withhold the students here only. Final anyway you have done articleship, you have a reasonable knowledge and things like that. So let's not hold. When we used to write, it was ulta case. Foundation, to literally they used to sleepwalk. Clear. Inter also manageable. Final, they used to have seen so many people struggle. 10 attempts, 12 attempts, 15 attempts and all we have seen. I think that doesn't make sense. I think this approach is much better. So don't worry. Just one more, you clear off this more or less degree in your hands. Only inter you have to clear. Final, I think ICA is giving you award only. Yeah, directly they'll giving you. Yeah, come back to the question. I think we didn't solve this question fully, no? Okay. I think let's not deviate. Oh, already 2 word. Okay, you people now, you make me talk so much. All right, listen, Guru, listen. Sorted. All those adjustments. I don't think so. We have any adjustment. That's all they've given. We have finished working note number 1. Reiterate back to me. What is that working note number 1? Shareholding percentage. Done. Second, general reserve of subsidiary company. Third, P&L of subsidiary company. Fourth, analysis of reserves and surplus of subsidiary company. The most important working note. First, in working note number 4, first classify the reserve as pre and post, and then allocate among holding company and minority interest. We are doing it at total level or individual item level. Each component we are going and identify whether it is pre or whether it is post and go on distributing. If due to that component reserve balance, if it is increasing, you show it as a positive distribution. If due to that particular component, if reserve balance is reducing, we show it as a negative component. That's a simple way of apportionment. Danaji, this is over, means rest all format will take care of. Working note number 5. What is working note number 5? Minority interest. They'll ask 3 things. Their share of share capital, their share of profit. Now profit is distributed as pre and post. Check the balance sheet. What is a subsidiary company ka share capital? 1 lakh. Minority will get entire 1 lakh or their share. What is their share of? 20%. So in minority, 1 lakh ka 20%. Where is it? Where went? 1 lakh ka 20%, which is 20,000. And minority will ask for their share of pre-acquisition profit. This is pre-acquisition profit. This is minority ka share, which is how much? 17,000. Consider check 17,000. One more thing, post acquisition profit. This is minority interest. This is post acquisition profit, and their total is 11,150. Add these and you'll get 48,150. This will come in your consolidated balance sheet. Okay, next, working note number 6 for goodwill or capital reserve. Again, same format. First is what's the cost of investment. Okay, now check. Have they given how much did the holding company pay? Here they have not given. I think you may have some information in balance sheet. If you check under non-current asset, there is other non-current investment. Don't directly take this. Whenever they have given a note, always make it a point once to check in the note. Because holding company may have purchased investment in subsidiary and they could have some other investment also. Go to working note number 4. What are they saying? The other non-current investment ka breakup, if you check, total is 6 lakh. But shares in subsidiary company for that parent or holding company paid only how much? 4 lakh 40. Means in the 6 lakh, 4 lakh 40,000 is how much holding company has paid to get the control over subsidiary company. This balance 1 lakh 60,000 is what? Other investments. Other. Oh, okay. I read it other way. Okay, fine. No problem. Non-current other investment is how much? 440, and shares in S Limited is valued at 1 lakh 60,000. Basically, they've given here 800 into 200 will give you 1 lakh 60,000. Fair enough, huh? So cost of investment is 1 lakh 60,000 given in balance sheet. Format, you tell me. At least that way we will try to remember here. Cost of investment, then reduce pre-acquisition profit, reduce pre-acquisition dividend, reduce the share capital. Positive number goodwill, negative number capital reserve. Okay, check this. This we have captured. Pre-acquisition profit. Holding company ka their share of pre-acquisition profit is how much? 68,000. Yes, sir. Why are we reducing? Tell me once again. Why are we reducing this? Logically, holding company should get this or they should not. They should not. But are they getting it? Yes. Hence, we are netting off this from the cost of investment. In real terms, the cost is not 160. It is much lower. In this problem, pre-acquisition dividend is not there. As I've said, AS 13 says pre-acquisition dividend should be reduced from cost of investment. Hence, we do this. If it is there, bring it in here. Done, ji. Okay. Then face value of share capital. What was the share capital of subsidiary company? 1 lakh. Entire 100% holding company owns or only 80%? So, holding company ka their share of share capital is 1 lakh 80%, which is 80,000. Net of this, you're getting a positive number. So, it's a case of goodwill. Show this goodwill in consolidated balance sheet. Done, ji. Done, ji. Okay, maybe this I'll take it up later. All right. Last one is working note number 7, which talks about consolidated reserves and surplus. Walk me through again. What are the things you'll consider? First, take holding car reserves as it is because no adjustment. Then, do not forget capital reserve. In this problem, capital reserve is not there. We have a case of goodwill. That is okay. Then, post acquisition profit you add. Stock reserve adjustment if you have, you add. But this should only be what? Downstream. Because if it is upstream, it will come under working note number 4. I just written it as a format. I think in this problem, we don't have this also. We don't have pre-acquisition dividend. We don't have any stock reserve also. But we do have, I think maybe we'll go back. What are the reserves holding company has? H Limited, the holding company, they have general reserve of 2 lakh. They have P&L of 1 lakh. Take that as it is. 2 lakh and 1 lakh. We don't have any capital reserve here. To this, add what? Post acquisition profit of subsidiary company. Minority ka share or holding ka share? Holding company ka their share of post acquisition profit is 44,600. Consider that, and these two are not there. And this final number comes in your consolidated balance sheet under reserves and surplus. Same format. Every question we have solved under same format. It works. Okay, that's the reason format. Not that it is mandatory. I felt it will be easy, so I've stuck to that. Your call whether to continue or not to continue or bring in your own creativity there. Okay, Ji. All right. Now, the requirement of the question was to prepare consolidated balance sheet. But what we did all is working note. But using this working note only, we'll be able to prepare consolidated balance sheet. That is the easiest, very, very straightforward stuff. Okay. All right. Because simply what you have to do, take holding company ka data, add subsidiary company ka, but there are certain adjustments which we get it from our working notes. Okay. Now let's take up one by one. What is holding company ka share capital? 6 lakh. What is subsidiary ka? 1 lakh. Can I add these two and call 7 lakh? Why? Sir, for subsidiary company, it may be share capital, but for holding company, it is an investment. Same component, can you show both as an investment and share capital? So first thing is, share capital of subsidiary company will not come in consolidated balance sheet. Instead of that, what will come? Goodwill or capital. Done now. That means what will come as share capital in consolidated balance sheet? Only holding company ka, which is 6 lakh. That's what I've shown you. This is your consolidated balance sheet. Share capital will be shown at 6 lakh. Yes, sir. After share capital, you show reserves and surplus. For reserves and surplus, anyway, we have done working note number 7. So take the number from working note number 7. So what is the value we got as per working note number 7? 3,44,600. So that I've just taken here and dumped it. Okay, Ji. Preference shares, it depends, where it is accounted under. Okay, so like it depends on who's holding that preference shares. So if it is there, preference shares you can show. But suppose parent company has invested in preference shares or subsidiary, then it will get knocked off. But they'll be at same value, so it will be 0. It will get perfectly knocked off. Otherwise, it will come. Okay, that way you'll have to capture that. But usually it gets captured. We show it under. We add it to the minority interest value. Because see, when we say consolidated balance sheet, no, right? This is prepared from H Limited group perspective. The group has not issued preference shares, meaning H has not issued preference shares. So we add it to minority interest value and show it there in case we have preference shares. Rare, but could be a possibility. Okay. Now people, another one is do not forget to show minority interest. How much is the minority interest balance? So working note number 5 or something had our minority interest. How much is minority interest? Minority interest balance is 48,150. So that also gets captured under consolidated balance sheet. After this is pretty straightforward. All other assets and liability go on straightforward adding. Check the balance sheet. What else is there? Trade payable 150. Take your calculator. 150 plus 57. How much is that? 2,07,000. I've written minus 0. Why minus 0? If there is any mutual owings, you should not forget to reduce. In this problem, not there. But in your examination question, they may say debtor-creditor relationship exists for 10,000. In that case, you have to reduce 10,000. So mutual owings, if it is there, eliminate. In this problem, not there. So straight away, that number is same, 2,07,000. So the liability side or total of balance sheet is ready. Asset. Asset 2, you need to be little careful because for consolidation purpose, we are considering carrying amount or fair value. And fair value, they have given it in adjustment. This is another area where there is a slight possibility of making an error. One easy way I'll tell you. What you simply do is, first we'll go to note number 3. Pay attention to this. Go to note number 3, they've given breakup. Machinery value, how much? 3 lakh. How much is the subsidiary ka value? 90,000. Whatever value is given in the balance sheet, add. Done now. But this 90, is it market value or carrying amount? Carrying amount. But for consolidation purpose, we need carrying amount or market value. So that means to this, what you have to do is add fair value adjustment. From carrying amount, if you add fair value adjustment, automatically you will get market value. That way you can do. Yes, sir. Pakka na. Once more, I got it. Okay, come back to the question and check how much is a fair value adjustment for machinery. Book value was 1 lakh. Market value was 1,50,000. So fair value adjustment is how much? 50,000. So add 50,000. Easy. Pakka. Now for consolidation purpose, we are ignoring 50 or considering 50. Sir, if you are considering this 50, on this 50,000 also you should depreciate. We have to calculate now or already done? Due to depreciation, asset balance will increase or reduce. Then you do minus depreciation. That we have, again, I think we have already calculated. How much is that? In 1 minute, I'll show you the interesting here. Excess depreciation and machinery is how much? 5,000. Reduce that. How much are we getting? 4,35,000. Same drama, we'll have to do it for furniture. So holding company ka it is 0. Subsidiary ka 17,000. Then what you will do? Now no fair value adjustments, no sir. If it is increase, you will add. If it's a gain, you will add. If it's a loss, reduce. On furniture, what they had given, check. Book value of the furniture was how much? 20, but market value was only 15. So it's a case of revaluation gain or revaluation loss. So due to revaluation loss, asset balance will increase or reduce? Reduce. So what we have to do? Minus. So we'll have to minus 5,000. Okay. Now depreciation you are charging or reversing. So that means depreciation now you will minus or add. How much was that? We already calculated it to be 750. Added. How much is that? 12,000. If you add these, you will get the total property, plant and equipment ka value. Add this and quickly tell me what is the number. 4 lakh. 4 lakh 41. Oh, actually, sorry. This is actually not 0, sir. One line has come below. This is 150 actually. Add 150. It's come here. This is what, sir? 160 to 750. So adding these two, finally you'll get. Here they are saying 5,97,750. Are you getting the same number? This number 597,750. Okay, now that's all it is. So simply add fair value adjustment and account the depreciation. That way it's easy, so you don't have to look at any other working note. But yeah, this is another area where there is a possibility to do some mistake in hurry bari. Okay, this is sorted. Sir, I have one doubt, sir. Holding company has only 80% control, sir. Holding company has only 80% control. So you should only add 80% assets. Got your doubt? Holding company owns how much percentage stake in subsidiary? 80%. So if you have only 80% control, you should only add 80% of subsidiary ka assets and 80% of subsidiary ka liability. Yes, no? That's not the way it works. When you get a control, it's like I used to give the same example in class. Suppose subsidiary company is planning to use the machinery for 10 hours a day. They're planning to use the machinery for 10 hours a day. Will holding company say, first 8 hours, I will tell you what to do. Next 2 hours, you do whatever the hell you want. Does it work like that, or it's a full control? By having more than 50% stake, holding company will be able to control the subsidiary company full. Hence, we don't add 80% assets and liability. Rather, we add 100% of subsidiary ka assets and liability. Easy. Okay. But if subsidiary company shuts down, holding company will get 100% from subsidiary or only 80? 80. Who will get 20? Minority. Hence, in consolidated balance sheet, we also show minority interest on the liabilities. On the asset side, you consider 100%. On the liability side, you show minority interest for 20%. 100% here, 20% in liability side. When you net off, it comes to 80%. That's the reason add assets and liability 100% and also show minority interest corresponding. So that effect will be netted off. Yes, sir, Saru. Okay, Saru, if you say so. He's saying, sir, goodwill you forgot. Goodwill will consider much. So an intangible assets, we have to take goodwill. That came from working note number 6. Remaining assets and liability as it is. Or maybe this one alone. Investment alone, I will tell you. What was the investment ka working note that they have prepared? 4. Come to working note number 4. What is the breakup they have given? Holding has 2 investment. One, they have some other investment for 440. They have subsidiary investment for 160. Sir, can this 1,60,000 come in consolidated financial statement? Can this 160 appear in consolidated balance sheet? No. Why? For the holding company, it is an investment. But for subsidiary company, it is share capital. Same thing you cannot show. In fact, we netted off this and what did we calculate? Goodwill or capital reserve. So this will not come. What about other investment? Other investment you will net off, or that can come. So this is other investment. No. These two you add. How much you going to get? 5,90,000. So they must be showing 5,90,000 in consolidated balance sheet. You can reconfirm. Yeah, this is 5,90,000. Current asset is not there. Usually they will give some data. But do not forget the stock reserve, mutual OAs. Stock reserve you will have to eliminate from inventory. Closing stock. Okay. and your mutual owings from debtors bill receivable, you also need to eliminate if at all they bring in that adjustment. Sometimes they do, sometimes they don't. But anyway, you know how to make the balance sheet tally. So that's not, you're not a stranger to it. Some or the other hook or crook, you'll match some things, no? Yeah. But it's okay. I think the working notes, if you are done in consolidation, especially working note number 4, I think more or less consolidation is set. Probably another one is time. Lengthy. Half an hour maximum. 25 minutes you should finish all this. Max. That can be a little bit of a tricky area. Because we will not have so much time to, I mean, if you have to complete the paper, your writing speed has to be good. That is one area probably you need to focus on a little bit. Okay. Yeah, I'll leave it to you. But sir, again, don't freak out by all these things. Okay. Oh, sir, so much, sir. So this is a ICA is not expecting you 100 on 100. You know, passing mark is only 50. Passing marks is 40. In aggregate, at the best institute is expecting 50. That means for every 2 questions, 1 question can be wrong. ICA is only telling 1 question you make wrong, it's fine, I'll accept it. So it is fine. Out of 100, can't you score 50? Yes, sir. This we will score. Big deal. Yes, no. With little efforts, with little confidence and practice, it will happen. So you believe that we and all have cracked? No. You believe I am a CA? Yeah, right. No. So if I can do it, so can you. If a dumb guy like me can do it, a brilliant chaps like you, oh my God, you too will be somewhere else only. Yeah. Done. Okay, this is sorted. Oh. It's getting late now. Every question is getting late. I have one more to be done. I think I have to do that. That is consolidated P&L. Okay, maybe this alone people I'll tell for someone's interest. 5 minutes of this, 1 question on consolidated SPL, and this chapter will be done. I said this chapter will be done. Yeah. What? You didn't get it, huh? That's the way life should be, macha. You should never hear negative comments. It's like chill pill. I didn't hear only. I just said another 1 hour we will spend, macha. Okay. Fine. At least this I'll finish. Give me time to finish at least this topic, noda. Okay. In our team told you can take whatever the time you want. You take till 6 o'clock also they told, pa. And here you are telling 2:30 only. Ayyo, puyo, you are telling. What the? Enough da, continue saying. Okay, look at this. X Limited acquired 90%. Just an example, just to make one point. I'm trying to tell you, we calculated an amalgamation goodwill in one fashion. Consolidation ka goodwill we slightly worked out in different way. I'm trying to say both are same. Just throw this example, check. X acquired 90% of Y. So X is a holding company, Y is a subsidiary company. On 31st March 2024, I have taken it at the year end. Date of control, in the last problem it was year beginning. Here I have taken it as year ending for simplicity. And how much? To get the control holding company paid? 12 lakh. Now I have given you a simple balance sheet. Let's say this is the balance sheet of Y Limited. Subsidiary company ka balance sheet I have given in T format for just explanation sake. Balance sheet always presented in Schedule 3 format if it's a company. Alright. So property, plant and equipment or fixed asset I've assumed 10. Current asset I've assumed 5. So total asset is 15. On the other side, equity share capital, reserves and surplus, I've assumed it to be 2, 10 and 2, and current liability 3. Balance sheet is okay. Alright, first let's work out under the way we just now worked out here. This method. Okay. Control has been obtained, correct? No. Control is obtained. Do you agree with me? With 90%, obviously you do get control. Give me goodwill working note ka breakup. Working note number 6. Quickly. Goodwill working note breakup. Cost of investment. Reduce pre-acquisition profit. Reduce pre-acquisition dividend. Reduce share subsidiary company ka face value of share capital full or holding share. Holding share. Positive number goodwill, negative capital risk. That's what we said. So okay, let's first work it out in this way. What is cost of investment? 12. Considered yeah. There is no pre-acquisition dividend because we form simply an example. So that is 0. Now, sir, how much profit? I've assumed this to be P&L, okay? How much P&L balance is existing on 31st March 2024 as per balance sheet? 2 lakh. And shares were acquired on, control was obtained on what day? End of the year only. End of the year only control was obtained. That means on the day holding company got control over subsidiary company, this reserve balance of 2 lakh was already existing. I mean, entire component is post or pre. Pre. Do you agree? Because this was already existing on the date of control. So entire 2 lakh becomes pre-acquisition profit. Okay, Naji? What should we do for pre-acquisition profit? Reduce full or their share. What is holding ka share? 90%. So calculate 2 lakh ka 90%. 2 lakh ka 90%. 1 lakh 80,000. Reduce. Say I've done this pre-acquisition profit 2 lakh ka 90%. 1 lakh 80,000. Any problem? Then reduce share capital. What is the share capital of subsidiary company? You'll take full 10 lakh or only holding ka share? What is holding ka share? So 10 lakh ka 90%. How much is that? 90. By doing this plus minus calculation, you are getting 1 lakh 20,000. This is the way we worked out goodwill under consolidation. Yes, Saji. Now let's go back and work it out under amalgamation method and see how it comes out. Okay. You remind me, how did we calculate goodwill in amalgamation? Compare net assets with PC. Compare net assets with PC. Okay. Now, how do you get net assets? If they don't give any information, all the assets have been taken over and they've been taken over at book value. What is the total assets? 15. What is the total liability? 3 lakh. Calculate what is the net assets for me. 15 lakh minus 3 lakh. How much is it? 12 lakh. That's what I've written here. Done, Aji. Correct, Aji. How much is PC? To get the control, how much money X Limited paid? 12 lakh. You can call that as PC also, one and the same. You can call it as cost of investment or you can call it as PC. How much was it? 12 lakh. Let's look at it in that way. So the cost of investment or PC is how much? 12 lakh. We used to compare PC with net assets. But here you need to be slightly careful. What is it is? Sir, did you get 100% control in subsidiary company or only 90%? So, if this PC is for 90%, can you compare this with full net assets or only your share? Getting the point? To get goodwill, we compare PC with the net assets. Since PC you paid to get only how much control? 90% control. Can you take full net asset or only your share of net assets? What is the net assets? 12 lakh. 12 lakh ka your share is how much? 10 lakh 80. Now compare PC with net assets. How much are you getting? Did the number change or same? One and the same. Whether you work out under that or whether you work out under this, it is one and the same. Because it is not different. In fact, the flow chart is like this. On the day, I think I've told you this in regular class. On the day you get control, you apply AS 14. You apply accounting standard 14 and calculate what? Goodwill. Right? So, AS 14 is one-time application. On the day you get control, you will apply accounting standard 14 amalgamation or merger or whatever you can call it, right? After you get control, till the time you lose control, every year you have to prepare consolidated financial statement as per accounting standard 21. So goodwill calculation is as per AS 14, but consolidation treatment is as per AS 21. So consolidation and amalgamation are not different. Consolidation is just a continuation. To consolidate, you need to have control. But what used to happen in our amalgamation is, it never used to be 90% control. It always used to be 100% acquisition. That's all is the difference. At inter syllabus, all your amalgamation is always 100%. In CA final, you will get all this. Okay, so it's one and the same. So it's just a continuation. On the date of control, you apply AS 14. And from there onwards, every year you have to prepare consolidated financial statement as per AS 21. Hence, this calculation will not be any different. It will be one and the same. Yeah. Okay, Naji. Okay, sir. Now everything will say okay only. Yeah, done. Okay, sir. One thing I would like to probably say is, last problem we did consolidated balance sheet. Another type of problem which can be asked. There are 4 or 5 types of questions, but in the interest of time, I can't cover them all. Another popular question for an 8 marker, 10 marker or beyond is they also ask consolidated P&L. So we will look through this question and learn consolidated P&L, how it works, and then put an end to it, into this chapter. Class is beginning. Hey, okay. Yeah, that's okay. That's fine. You can. If anyone wants to attend the costing class there, you can leave and attend, and we'll anyway upload this also. So it's fine. Uploading will take some time, but you can manage that. Okay. Now, Moon, sir, 1 second. P&L format, do you know? Schedule 3 format. Throw it back. First, you will give the heading O, then you will give income, under income, revenue from operations, other income, and then you will get total income. Then Roman letter 2 expense. So under expenses we have various categories. Cost of material consumed, purchase of stock in trade, then changes in inventory. Then you can remember it as EFD. EFD. E for employee benefit expense, F for finance cost, D for depreciation and amortization, O for other expense. From income minus expense, if you do, you will get profit before tax, and reduce the tax and you will get the profit after tax. That's what you'll have to do here. Okay, people. Same as balance sheet. If you have any mutual owings, here in P&L, the big adjustment is your mutual owings. That you need to be careful. In balance sheet, what do you do? What did you do for mutual owings? Eliminated. In P&L also, if there is any mutual owing transaction, eliminate. How? Purchase. Holding company has sold goods to subsidiary. Holding company has sold goods to subsidiary. For holding company, it is a sale. For holding company, it is a sale. For subsidiary, it is a purchase. So from sales also eliminate. From purchase also eliminate. Holding company has given some service to subsidiary company. That means for holding company, it is an income. For subsidiary company, it is a expense. Eliminate that. So they will give you like 2-3 mutual owing transaction. Eliminate that. Okay, and probably another big ticket one adjustment is stock reserve. There you can go do mistakes. Rest everything format will take care of. It's a pure format. Nothing to worry about that. Quickly, we will run through one question. You will get to know what I'm saying. If you want for stock reserve also, I'll tell you one quick formula, fix to remember it. I've told you the logic, but yeah, we will see. I think time will not permit. So Moon Limited and a subsidiary Star Limited have provided following information as on 31st March 2021. Sir, I will read out the component. All you have to do is tell me whether this is a balance sheet item or a P&L item. If it is P&L item, under which category it will come? That you need to identify for me. We just need to prepare consolidated P&L here. That's the requirement. Okay. All right. So now, yeah, first one. Share capital, balance sheet item. So any consideration or ignore. We are preparing consolidated P&L. So this one totally we can ignore. Now, finished. Check the dates always. You need to, they have given the information as on 31st March 2021. That means this is a year ending information. Okay. Check the dates. Finished goods inventory, finished goods ka closing stock as on 1st April 2020. So current year is ending on 31st March 2021. But they have given stock value as on 1st April 2020. So what is our current year basically here? 1st April 2020 to 31st March 2021. This is our current year. They have given you finished goods ka stock on 1st April means it is a closing stock or opening stock. They have given opening stock, which is parent company ka or holding company ka, it is 42 lakh. Subsidiary ka 30 lakh 10,000. Where will this come? Perfect. There is something called changes in inventory. In that category, it will come. How do you calculate changes in inventory basically? Opening stock of WIP. If you want to calculate changes in inventory, the thing is, you will take opening stock of WIP. You add opening stock of finished goods. From this, reduce closing stock of WIP and reduce closing stock of finished goods. By doing this, what number you get, that only we call it as changes in inventory. Okay, Ji? I think you must have anyway practiced all that. So it's okay. I'll not go too much into that. Sir, in most of the problem, WIP information will not be available. They'll only give you finished goods. Okay, calculate. Take your calculator quickly for me. We'll review. Opening stock was how much of finished goods? 42 lakhs. Same finished goods ka inventory, they have given it on 31st March 2021. So what is this? Closing stock. So don't compare these two people. This is holding company ka, this is subsidiary ka. Don't do that comparison. We do same company ka opening stock and closing stock ka comparison. Opening stock was how much? 42 lakh. Closing stock is how much? 85 lakh. So these two you minus. Don't change the order. Take it in the same order. 42 lakh minus 85 lakh, 75,000. How much is it? That will come and where? Change. See, once if you want, I'll just show you. This is the format of P&L. See if you're comfortable. Revenue from operations, other income. Then cost of material consumed, purchase of stock in trade, changes in inventory. This is EFDO if you want to remember that way. So what component we just now discussed? The finished goods ka inventory. That will come under which category? Changes in inventory. When they ask you to prepare consolidated P&L, the main thing which the examiner is looking for is the format. Because here there are no adjustments. So you can't write everything in the inner column. If you do that, you will not even get 50% of marks. You will have to prepare them with the detailed notes. Because it's pure format, taking the data and dumping into the format. So you have to do notes to accounts here. You can't escape. Otherwise, as I said, marks will be taken away. So changes in inventory, I prepared note number 4. How much did you get? You said you got it? Working note number 4 here. Here, 43 lakh 75,000, positive one, negative one. Negative. Done now. This is for which company? Holding company. Same thing you do it for subsidiary company. These two you might net off in the same order. How much are you getting? Quickly do. These two, if you eliminate or if you net off, you'll get how much, sir? 7 lakh 52,500. Yes, no. So whenever we identify, we'll tick off. Other things we'll see it later. So again, consolidated P&L is very straightforward. Take holding company ka income and expense. Take subsidiary company ka income and expense and add line by line. Mutual owings you need to eliminate. That is one. One stock reserve adjustment they may ask you at best. That's all is I think maximum adjustment which gets targeted in consolidated SPL. Conceptually pretty easy. Nothing much to worry about. Okay. Dividend income. Where will dividend income come under? Do we have any category or no category? If there is no category, it comes under other income. So check 16. Quickly take your calculator, add these two. 1680 plus 437,500 under other income. See here, note number 2 I prepared for other income, or maybe I've listed out individually. Moon ka this, star ka that. Same number, okay? Alright, next, this is done. Non-operating income. Do we have any category called non-operating income? No, I mean this also where it will come. Other income only. 350 and 105. I've taken a 350 or here it is there. 350 and 105. Other things we'll see later. Okay, next what else there? Raw material consumed. Where it will come? For raw material consumed, there is a separate category called raw cost of material consumed. Take that. 1 crore 39 lakh 30,000 and 47 lakh 25,000. Check, I've taken a. For cost of raw material consumed, I prepared note number 3. Under note number 3, same number added off. Just adding these two. Other things we'll see later. Okay, next, what else is there? Selling and distribution expense. Sir, do we have any category for selling and distribution expense? If you don't have any category, it comes in residual category called other income or other expense. There's an income or expense. So this will come in OE. OE as in other expense. 33 lakh 25,000, 15 lakh 75,000. For other expense, I prepared note number 2, 3325 and 15 lakh 75,000. Take the number and dump it. No calculations. That's it. Okay, next, production expense. Production expense, since it's a direct expense, we recommend that you show it under raw material consumed itself. Under raw material consumed itself, you show it. How much is that? 3150 and 14 lakh. Under raw material consumed, where is it? Here. Under raw material consumed, you can show production expense 3150 and 14 lakh. Again, no calculation, just dumping. Next, what else is there? Loss on sale of investment. So usually from investments, we expect to earn some income, right? You will have one investment or you will have many. Hence, loss on sale of investment, we don't show it under other expense. Rather, we deduct it from the other income. Rather, we reduce it from the other income, because from other investments, you would have earned some income. That income you are showing where? Under other income. So this loss also you show it under other income, but as a negative. So this is 262,500 and 0. You reduce it from other income. Under other income, here check at the end, I've written loss on sale of investment. You have reduced to the extent of 2,62,500. Okay. Next, what else is there? Sales and operating income. For sales, we have revenue from operations. Take the number as it is and punch in revenue from operations category. Same. Nothing. As of now, no adjustments. All adjustments, I think they've given separately. Wages and salary, where it will come. We have employee benefit expenses as a separate category. Show that. Same 1 crore 33 lakh and 24 lakh 50,000. Employee benefit expense, working note number 5. Both numbers, no adjustments. Take the value as given in the question. General administrative expense paid, royalty paid. Both are, do we have any category or no category? I mean, both of this will come under where? Other expense. So same number, take it and dump it into other expense format. This is your other expense. General admin expense, same data from question. Royalty also 0 and 50,000. Question ka data, numbers I'm bringing it in. Okay, depreciation. For depre, we have a separate category. Yeah, depreciation and amortization is a separate category. So show it there. 315 and 140. Where is it? Here. 315 and 140. Same number. Next, interest expense. Interest is a finance cost. For finance cost, we have a separate category. So show it there. 175 and 52,500. Where is it? Here, fine. 175 and 52,500. Both are added up. Now, these are the data given to you in the question. We have taken it and dumped it. Now, some adjustments they have given. Some 4 or 5 they will give. That's pretty much the expectations. Okay, check. Sir, our current year is this. Keep this in mind. On 1st September 2018. 2018 is current year or almost 3 years back? 3 years back. What happened? Moon Limited acquired 50,000 shares of 100 each in Star. So the date of control is current year or 3 years back? 3 years back. But anyway, we are not preparing balance sheet. So this is not much useful to us in consolidated P&L context. Check the second one. Star Limited paid a dividend of 10%. Star is a subsidiary company. They paid a dividend of 10% for the year ended 31st March 2020. That means it's a normal dividend only, because we became shareholder when? 2018. And this dividend is for which year? 2020. Pre-acquisition dividend or normal dividend? Normal dividend. The dividend was correctly accounted by Moon. So they've correctly accounted, it's fine. But there is a small problem here. What problem? Sir, how many shares has, sir, if subsidiary declares the dividend, who will get? If subsidiary company declares the dividend, who will get? Shareholders. Who are the shareholders of subsidiary company? Holding and minority. This only is your. First what? Mutual owings. Mutual owing means transaction between these two companies only, no? Subsidiary, if they are paying any dividend to holding company, obviously it is a mutual owing, no sir? Can we show mutual owings or eliminate? Eliminate. Why are we eliminating? Tell me the logic behind that. Because legally there may be two companies, but for consolidation purpose, are we treating them as two company or one company? One company. So can we show this or eliminate? Yes sir. Okay. Now we have to find out how much dividend parent company or holding company received. Subsidiary declared how much dividend? 10%. How many shares does the holding company have? 50,000. Each ka value is how much? 100. If they don't give anything, we'll assume that 100 itself is face value. Calculate. 50,000 into 100 is how much? 50 lakh. Dividend was declared at what rate? 10%. So if you calculate, you will get how much? 5 lakh. Any problem in there? This 5 lakh parent is showing as what? Income. For holding company, it is an income. Yes, now can we show this or eliminate this? Eliminate. You remember you accounted dividend income here? Can we show this dividend income or it includes MO? It includes mutual owings or MO of how much? 5 lakh. So what we should do? Eliminate. Check. From the dividend income is 5 lakh eliminated. This is your dividend income. This is your subsidiary card dividend which gets eliminated. Done, Aji. And this is the final dividend that gets triggered. Okay. So mutual owings you have to eliminate from two places, no sir? Like debtor, creditor. But here we eliminated only from one place. What is other treatment? Sir, is dividend an expense? Is dividend an expense or appropriation? Your P&L stops at a certain line item. Can you tell me what is that? Your P&L stops somewhere. What is that stopping item? Profit after tax. Your P&L stops at profit after tax. You will pay dividend what? After paying tax. So dividend will not affect your for the company paying dividend, their P&L will not get affected because dividend adjustment is done through note number 2, reserves in surplus. Note number 2, reserves in surplus. So hence, dividend paid ka you don't have to do any adjustment. You have to do that adjustment provided you're preparing reserves in surplus. Here, am I preparing reserves in surplus or I am not preparing? Not preparing. Yes, there also it will get eliminated, but I am not preparing that. But dividend income is shown where? Dividend income is shown where? Under other income. Other income, will it affect P&L? Yes. As one elimination will happen here, another elimination will happen in note number 2, reserves and surplus. And we are not preparing reserves and surplus ka note, so hence we don't have to agree. I mean, we don't have to worry about that. Did we get that? Pakka. 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 Pakka, sir. Okay, sir. Next, sir. Moon Limited. Moon is the parent. They have sold, or Star is the parent. No, Moon is the parent, I think. Yeah. All right. Or parent or holding company. It's fine. CA final may we call it as parent. Sometimes I get the nomenclature juggled up. Okay. Moon Limited sold goods for 17,50,000 to Star. Okay. So holding company has sold goods to subsidiary or whatever, it doesn't matter. For one company it is a sale, for another company it is a purchase. Sales also will come in P&L, purchase also will come in P&L. So ignore or eliminate. Eliminate. Why? Because this is a mutual owings. How much to eliminate? 17,50,000. So we have already shown sales. From sales, reduce mutual owings of 17,50,000. One adjustment. Done, Aji. Only sales or even purchase also? Purchase also. Sir, have they given purchase of stock in trade separately anywhere? Because in P&L, we have a separate category called purchase of stock in trade. Did they give that? But they gave only what? Raw material consumed. That means indirectly what it is trying to hint. We are not purchasing finished goods. We are only purchasing raw material. Okay, so from sales you have eliminated, no? So from purchase also you eliminate. And what have we purchased? Finished goods are raw material. So from raw material consumed, where is the raw material consumed ka working note pa? Here. Cost of material consumed, eliminate the mutual owing. Why is this elimination? Tell me once again. What is this? Purchases. What is this? Sales. So basically one income and expense both should be eliminated. But for dividend we can't do that. We can't give two adjustments. Why? We can only give one. Why is that again? Dividend income you will show it under other. But dividend paid is not an expense. It's rather an appropriation. An appropriation adjustment is not done in P&L. It is done from reserves and surplus. So second effect will be given there. Hence we can't show that. But for all other component, there will be two adjustments. At two places they will get eliminated. One from income also, another from expense also. Done, G. Okay. This is another important one. Check. Moon sold the goods to SAR for how much value? 17,50,000. At what profit? 20% on the selling price. Check this because there is one stock reserve adjustment. I need you to be careful. Inventory. 1 minute. Okay. How much is the sale value? 17,50,000. First, can you tell me total profit? Total sale value is 17,50,000. How much profit holding company made? 20%. How much is this? 3,50,000. Now you tell me stock reserve means what? Is it total profit or is it profit included in closing stock? Unrealized profit means profit included in the closing stock. It is not total profit. It is profit included in the closing stock. Correct? Now check what are they saying. Inventory of Star Limited. Moon has already sold goods to whom? Star. Now Star has that goods as inventory. Full value? No. Inventory of Star Limited includes only how much goods? So 7 lakh. We sold how much? 17,50,000. So all the goods are lying unsold or only 7 lakh? 7 lakh. So will you eliminate this as stock reserve or recalculate? Recalculate on 17.5 lakh or 7 lakh? 7 lakh. Why 7 lakh? Perfect. Only 7 lakh is remaining unsold as closing stock in subsidiary books. So calculate. How much is unrealized profit then? 7 lakh is the value and profit included is 20% on the selling price. So 7 lakh ka 20% is how much? 1,40,000. This is the important one. So don't eliminate 3,50,000. You have to eliminate how much? 1,40,000. Yes, sir. Sir, this elimination will come in consolidated balance sheet. No, sir. Why are you discussing in consolidated SPL, sir? P&L, sir. Sir, closing stock comes in balance sheet also. It comes in P&L also. It comes both places, no? So we'll have to eliminate here also. So yes, this is important. Yes, Saji. You want formula or you want logic for this 140? First, I'll tell you formula. I'll tell you one, maybe in the interest of general audience, we'll keep. Whenever you see stock reserve, anyway, inventory will come in which category? Inventory in P&L will come in which category? Changes in inventory. Simply add. Doesn't matter what is the value, whether value could be 1 rupee or 1 crore rupee. Doesn't matter. The sign is always pakka. What is that sign? Plus. That's it. You don't have to look at this number, no number. Stock reserve means what? In this working note, stock reserve means add. How much value? 140. Add 140. Formula. Okay, na? Easy, na? So no load. Simply add, answer is correct. Now, if you want to know the logic, it's very simple. How do you get changes in inventory? We'll take finished goods now. You will take opening stock of finished goods. From this, you will eliminate closing stock of finished goods. Let's say opening stock is 1 lakh. Assumption. Closing stock is 80,000. How much is changes in inventory? 20,000. Any problem? No? Okay. Stock reserve ka meaning. Tell me once more. Stock reserve ka meaning. What is it? Stock reserve means profit included in closing stock. Profit included in. It is already included. Should we include it or eliminate it? So, one profit is already included in closing stock, which we need to eliminate. When you eliminate profit, closing stock ka value will increase or it will reduce. Not how much. After Ramayana, you're telling Karna didn't come only. Okay, check this. Sir, 80,000 is a closing stock of finished goods. Profit is already included here is what I'm saying. Okay, let's say unrealized profit is 10,000. Unrealized profit is how much? 10,000. This 10,000 is already included in 80. Should it be included or we should eliminate? Okay, now recalculate. Is there any effect on opening stock or same? Same, 1 lakh. When you eliminate this unrealized profit, closing stock value will increase or it will reduce. So you're taking away 10,000 from closing stock, means 10,000 value of closing stock will reduce. That means closing stock will not be 80, from 80 it will become 70. Okay, now this is your opening stock of finished goods. This is your closing stock of finished goods. Now calculate changes in inventory. How much is that? 30,000. Yes, sir. Now instead of doing all this drama, how much is changes in inventory? 20,000. Simply add stock reserve. Unrealized profit. How much is it? 10. How much are you getting? That's the reason formula. No logic load. Stock reserve every time will be added. But if you change this sign, sometimes ICI does that. Then this will go for a toss. Don't do that. That's the reason I said maintain it in this order only. The formula will work perfect. It is always what? How do you calculate changes in inventory? Opening stock first number you will punch in your calculator. From that you will eliminate closing stock. And whether you get positive or whether you get negative, you will write it as it is. And then stock reserve you will simply add. Because due to stock reserve, closing stock value has to be reduced. Or another way if you want to remember, sir, opening stock has a direct relationship with changes in inventory. Meaning if opening stock increases, changes in inventory also will increase. Closing stock and changes in inventory have inverse relationship. If closing stock increases means changes in inventory will reduce. If closing stock reduces means this will increase. Whichever way you want. 3 types we have discussed. One way at least you keep it and do it. Okay, now if it comes. Done. This is one important adjustment. Selling and distribution expense of Star include 2,12,000 paid to Moon. Star and Moon again are transacting. So what is this? Mutual owing. In which mutual owings is visible here? Selling and distribution expense. One company has booked this as selling and distribution expense. Another company, for one company if it is an expense, for other company it will be income. So 2,12,500 first has to be eliminated from what? Under other expense, under selling and distribution expense. This is one adjustment. Expense has got eliminated. Mutual owings will have one effect or two effect. From expense we have eliminated. What is the second effect? other income में, from other income में 2,12,500 here. Where is that part? 2,12,000 only, no? Here. Brokerage. Yeah, I've just called it as brokerage. It's fine. I think they're calling it as brokerage only. Brokerage. So one entity, it's an income. For another entity, it's an expense. Both we have eliminated. Perfect. Next. What else is there? General administrative expense of Moon include 2,80,000 paid to Star as consultancy fees. So for one company, again, consultancy fees is an expense. Another one, it's the income. One place elimination or two place? Two place. Where and on? One under other expense. Under which category? General administrative expense. How much? General administrative expense, consultancy fees is 2,80,000. Expense has been eliminated. Where under income? Do we have any category for this income or other income? Under non-operating income, you can eliminate 2,80,000 as consultancy fees. Both eliminated. Next, what else is there? Star used some resources of Moon and Star paid 50,000 to Moon as royalty. Royalty paid is an expense for one entity, income for another entity. In income, do we have any royalty as a separate category or other income? Under income, you will eliminate it from other income category. Here, under other royalty, we don't have any separate category of expense. So it will be shown where? Other expenses, right? You will book royalty under other expenses. That also you eliminate. Rest or all, if you just check, none of the ticks are missing. The rest, everything is what, sir? Totals. Go to this total, ultimately P&L will match. Dividend, only one effect. Remember that. Rest of the mutual owing, two effect. And do not forget, stock reserve always addition. That's it. If you want it as formula. Rest everything, take line by line and add, but do it in proper format. Don't do everything here. Inside P&L, if you do, you will not get marks. Again, this also gets asked for 8 to 10 marks. It has come multiple times. Easy question. Time. Watch out for time. 20 minutes tops, not more than that. Yeah, I think this one is, we are, I think 1 minute. Let me quickly review. Okay, I think we have covered everything in this. Thank you.